Hello everyone, welcome to QuintEdge. This is CA FRM Chan, and in this video we are going to learn about valuation. So I've divided this video into two parts. The first part will be the theoretical base, and second part will be the practical. Okay, so for first couple of minutes I'll lay the theoretical foundation, and then we will keep moving to and fro between theory and practical. Okay. So firstly, let us start with theory. First thing that I want to ask you is, what is valuation? You must be having some definition around it, right? And number two, I'm going to give you certain assets and you have to try to value it. So try to value assets. Okay. So let's start with this one first. Okay. I'm going to give you name of certain assets. You have to tell me whether we can value it or not. So let me give you five most popular one. We have gold. We have Bitcoin. We have shares of company. Then we have a bond and US dollars. You have to tell me which of them can be valued. Okay, this is your answer. So you can pause the video and actually, like, I go through all the comments. So you can pause the video and write yes. Like if your answer is for gold, it is yes. So write yes, 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 no, yes, whatever it is the answer. Okay. So try to do it. Okay. Assuming that you actually pause the video, most of the people gave this answer. Gold, yes. Bitcoin, no. Shares of the company, yes. Bonds, yes. US dollars, yes. Okay. This is the answer that mostly candidates give. I want to give correct answer then. Gold, no. Bitcoin, no. Shares of the company, yes. Bond, yes. US dollars, no. This is the correct answer. So let me know in case you have scored 5 on 5. Okay. If in case you have scored 5 on 5, then it's amazing. You understand the concept. Otherwise, we need to discuss a lot of things today. Most of you would have given at least one wrong answer, right? So firstly, let me tell you what are the assets that can be valued. Only these assets can be valued, okay? Assets that are expected to generate future cash flows can be valued. Anything other than this cannot be valued. So if we look at this, try to think about gold. Is gold expected to generate any future cash flows? Many people say yes. Sir, I'll buy gold for, let's say, 60,000 rupees and I'll sell it for 70,000 rupees. So I'll get my cash flow. I'm not talking about that kind of cash flow. Inherently, does it generate cash flow or not? If you just hold it, if you're going to keep, let's say, a 10-gram coin of gold in your wallet and you keep it for 10 years, and after 10 years, it's again going to be 10 grams, right? It's not going to increase. Inherently, it doesn't generate anything. What you are referring to is price. Price is a function of demand and supply. Do all these assets have price in the market? Yes. But can we come up with its valuation? Answer is no. Like Bitcoin also no, gold also no. Do they have price? Yes. All of them have price. It is function of demand and supply. Value. It is a function of fundamentals. of that particular assets. Fundamentals, three basic fundamentals: cash flows, discount rate, and growth rate. At what rate the cash flow is going to grow, the current cash flow, and the discount rate. We'll discuss discount rate later, but these three are the fundamentals. Okay. Now think about share. If you hold share, what will you get? You just buy and hold it. Don't do anything. You will keep on receiving dividends. What about bonds? If you just hold share, what will you receive? Interest. US dollar, it's a currency. It can't be valued. If you just hold US dollars, keep 1 rupee coin in your pocket and let it be there for next 15 years. Still, it's going to be 1 rupee. But keep one share of, let's say, PI industry in your demat account. Look at it after 10-20 years. It would have been at least 5, 7, 8 share, because the company keep on splitting the shares, and then share price will also change, and they would have received dividend as well. A lot of things are there, right? So this can also be not valued. I hope you are clear with the basic fundamental. Okay. Now in this video, we are going to learn about discounted cash flow method. DCF, discounted cash flow. Okay. DCF can again be divided into two parts. DCF, by the way, is also known as intrinsic valuation. Intrinsic, inner, bhitari, right? Intrinsic valuation. Now, DCF, there are two models of discounting cash flows. One is called as dividend discount model. Dividend discount model. I'll call it as DDM. And then we have free cash flow model. We'll call it as FCF. Okay, free cash flow. Now, every business comes to life, grows really fast, the growth tapers down, then it declines, and then the business dies. Like, this is law of nature, right? If something is becoming alive, it have to die as well. So in maybe very distant future, Ambani family will be really poor. Adani family will be really poor. Maybe not right now, 100, 200, 300, 500 years down the line. But it is meant to happen, right? It was meant to happen. Think about the biggest and the largest company, East India Company, literally like ruled the entire nation. No more to be seen, right? So everything have to go through this business cycle, and it's perfectly fine. Dying is a very natural thing. Companies need not to be ashamed of this. So what we do is, if let's say I'm a shareholder, I can buy any point in time. Let's say I buy it over here, right? I just buy and planning to hold it for very long time. So if I'm going to sell share over here, it will be worth zero. The company goes bankrupt. So over this period, what I'm going to receive, right? The cash flows over here. I'll calculate their present value. Okay. I'll do it for every cash flow that I'm expecting to receive in future. I'll calculate their present value and we'll add it up. Sum of the future cash flows present value is equals to value of the asset. So you can remember this. Value of any asset, anything, shares, bonds, security, anything. Value of asset is equals to present value of its future expected cash flows. So what I'm saying is, there is no guarantee that we need that cash flow will be there, but there should be some basic expectation, some rational expectation that it will generate. Obviously things can go wrong, right? But in case we expect any asset to generate future cash flows, we calculate their present value, and whatever is the present value of all the future cash flows, that becomes value of the company. Okay. So if you are going to hold company for very long, the company will do sales. From that sales, or to achieve that sales, it will bear some cost, and there will be profits. There are only three treatment of profits that can be done. First is reinvestment. That is, let's say you buy a machine, so you do capex, machine, fixed assets, etc., to expand the business. You can buy other companies as well, right? Or you can invest into working capital, maybe buy more inventories, right? So one is reinvestment. Another one is distribution. Distribution, that is, give dividends. And what else could be done? Let's say I made profit of 100 rupees. I purchased land machinery of 40 rupees. 20 rupees I gave in the form of dividend. 60 rupees that is still there. 40 plus 20, 60, 40 rupees that is still there. It will be there. This is just lying idle in the business. This is reserves, right? Not distributed, but not invested also actively anywhere. Now, one theory says over the period of time, this reserves, some use will be there. Either it will be reinvested into the business or it will be distributed to the shareholders, right? The wealth will not keep on accumulating and without doing anything. It needs to be even given back to shareholders or will be invested in the company. So basically, we say this reserves, because whatever capex the company want to do, it will do. After that, only reserves is left. So this reserves also belong to shareholders and dividend also belong to shareholders, right? So first approach says reserves are ultimately going to become dividends and be distributed. So just calculate PV of all future expected dividends, and that will be value of company. This is effectively dividend discount model. Second approach says add them together. So whatever was your profits after you do capex, working capital, etc., investments into the business, whatever is left, that is to be utilized. Like company can distribute it, company can keep it with itself, whatever it want to do, it will do. So these are called as free cash flow. Cash flow that is freely available. There is no major use of it. Either give to shareholders or keep it with yourself. So combine them, it is called as free cash flow. Distribution plus reserves. It is called as free cash flow. So what we do is we calculate free cash flows to the company, free cash flows, and then we calculate PV of free cash flows. And this becomes value of the company. This is called as FCF model. Okay. Free cash flow model. Both the approaches are correct. Theoretically, practically, we might not get the same answer, but theoretically, ideally, these approaches should be giving the same value or approximately similar value. One more thing, valuation is always in a range. Valuation is in a range. It is not a point estimate. You can't say a share is worth rupees. You can't say a share is worth rupees 100. You can say share is between $90 to $110 or 90 rupees or 110 rupees. Exact value you cannot come up with because you are trying to future predict that what cash flows will be there. Discount rate is also very subjective many times. So you cannot come up with exact number, but we can say the share is not definitely worth rupees 1 rupee or not definitely worth rupees 50 rupees. It is somewhere between 90 to 110. Now it could be 92, 95, 98, 105, 108, but this becomes a broad range. Okay? So this is the basic concept. Now in this video, we are going to focus on this method, free cash flow method. Now, before I move ahead, let me give you the details about the case study. So the company that we are going to value is my favorite. I really love cold drinks. I really love aerated drinks. Though as I'm growing, the people have started to suggest me you should reduce the consumption of sugar, and I'm doing that. But yes, the company that we are going to value is Coca-Cola. Okay. The company is based in USA, so we are not referring to Indian company. And many students ask me, sir, why not Indian company? Process, etc. remain same. But what happens is, like in the investment banking course, especially, you guys will be working as a backend to the largest capital market. There is a high probability of it. You will be involved with US company very frequently. So I want to make you more accustomed of reading their annual reports. And obviously, I always encourage that we should be doing valuations and assignments on our home-based grown companies as well. But at least when we are learning for the first time, US disclosures are much better, right? That is the fact. You can't deny it. The disclosures are much better. Uh, like the information that they give is more qualitative as well as quantitative. Therefore, we use US companies to learn, and you can apply the same principles on Indian companies as well. Okay. So it's a US based company having its operations worldwide. Okay. Now I want to give you some information about US based companies. So US based companies generally releases three types of forms: 10K, 10Q, 8K. 10K is a form for annual report. So basically their annual report is called as 10K. Their quarterly report, no surprise, is called as 10Q. And press release, in case they want to release anything other than annual and quarterly report, where will they do it? 8K. It is press release. Many times, many US companies, before issuing their annual report and quarterly report, maybe 2-3 days before it, will give out a press release that we are going to come up with our annual report, quarterly report. And these are broadly the numbers, like sales for this is this much, profit is this much. More detailed report will be available in 2-3 days. Okay. And by the way, US companies mostly follow their financial year is the calendar year, that is 1st January to 31st December. Okay. Now, I'm just like before we start with the Excel exercise, I'm just moving to some off topic discussion. Valuation, broadly two approaches are there: intrinsic valuation and relative valuation. In this video, we are going to focus on intrinsic valuation. Within intrinsic valuation, two approaches are there: DDM, dividend discount model, and free cash flow model, right? Likewise, relative valuation also have two approaches. Relative valuation in simple ways is valuation by comparison. In this, there are two approaches: precedent transaction analysis and public company analysis. Precedent transaction analysis, look at historical M&A transaction, historical buy-sell transaction. So if, let's say, a large tech company in India operating worldwide was purchased at the P valuation of 30. So my company is also a large tech company in India having operations worldwide. My P valuation should also be 30. So if my earning, let's say I'm earning profit of 1000 crores. So my P valuation being 30, my value of the company will be 30,000 crore, right? So this is broadly how we do it, precedent transaction analysis. Same thing is public company analysis, where let's say if I want to find value of TCS, I'll compare it with P multiple of not historical data, P multiple today of Infosys, of Wipro, HCL, L&T Mindtree, and so many other, Cognizant, etc. Right? So many other companies. So I can come up with some broad estimate about TCS valuation by looking at other similar large IT players in India, right? So this is relative valuation. For this particular day, we are not going to focus on these things. Okay. Otherwise, like this itself is 20 to 30 hours of discussion that we generally do in our investment banking course, right? So this is something that will be covered in the classes later on. This is something that we will be discussing. Over this, dividend discount model is generally used for banks and investment companies. So since we are discussing a very simple FMCG company, we are going to use a free cash flow model. Now, going ahead, I can divide company into three broad phases. This is startup phase. This is high growth phase, or you can say this is high growth phase. This is moderate growth phase. This is stability. High growth, moderate growth, and stability. Okay. Now, this high growth phase have negative cash flows, no profit or losses, but high growth. You are reinvesting in the business a lot. So maybe this is what Swiggy, Zomato were there 3, 4, 5 years back. Now Zomato is profitable. It has entered into a moderate growth phase. So cash flows become positive. Profits are marginal. Stable growth phase. The cash flows are stable. You have captured the maximum market share you could capture. Profits are high. The margins are high, right? So when we do valuation, we assume the business will continue its operation for foreseeable future. In accounting, we call it as going concern, right? So why do we assume this? The reason is, let's say I'm saying the business will continue its operation for foreseeable future for very, very, very long time. Even if I'm going to receive, let's say 10 crore rupees, but if it is going to be after, let's say 150 years, in present value, it's not going to be even worth rupees 100 rupees. That's the fact. I have this calculator. Let me do the calculations. So ones, tens, 100, 1000, 10,000 lakh, 10 lakh crore, 10 crore. Divided by bracket open, discount rate of 10%, 1.1 to the power 150, bracket close, equals to, it is coming as 61 rupees. 61 rupees today or 10 crore rupees after 150 years. It's the same, right? That's the concept of present value. So what formula that you have applied? So formula is PV into 1 plus R to the power T is equals to future value. For example, if you do FD of 100 rupees for 1 year, so 1 plus, let's say FD is generating 7% interest, 7% to the power 1. So you'll get 107. So after 1 year, it's going to be worth rupees 107, right? So future value is equals to PV into 1 plus R to the power T. Very basic, right? This formula takes into the impact of compounding. Okay. So this is the formula that we are going to use. So in case I want to calculate future value, I do PV into 1 plus R to the power T. What if I want to calculate PV? PV will be equals to future value by 1 plus R to the power T, right? Remember this formula. Like if I'm going to receive 107 rupees after 1 year, interest rate is 7% per annum. So in today's term, its value will be 100, right? If I give you 100 rupees right now, you do FD and you get 107 after 1 year. Or I can directly give you 107 after 1 year, 100 right now or 107 after 1 year. It's the same thing, right? This is present value concept. Okay. So this is it. Now we are going to move to Coca-Cola. Now we have to download their reports. I have already downloaded them, but I'll show you how to download them. Okay. So go to your browser. This is the browser that I use. I'll go to sec.gov. I'll go here. Okay, SEC have like made changes to their website. So it is their new interface. We can write here Coca-Cola. A lot of Coca-Colas are there, right? Coca-Cola, Coca-Cola. We need this one, KO. Okay. So how do you know this? Okay. So if you just go and search Coca-Cola share price, you're getting this NYSE. That is, it is listed on New York Stock Exchange by the ticker. This is called as ticker identification symbol. It's like roll number of the company. When they are listed on exchange, two companies can have very similar names. Almost same name is also possible, but the ticker will be different. So it's their roll number, it's their identification symbol. Okay. So Coca-Cola ticker is KO. Going back, this is their 10K report and this is their 8K report. I'll show you how to download these. View on 10K 10Q. Then let's say I want to download this report. I'll click on this. Right, this is their report, but there is no option to download. So you have to go to menu, then click on open as HTML. Open as HTML. Now right click, or you can press Ctrl P, print, and then you can save this report as PDF. In some browser, you see option over here. When you select printer, there is option of save as PDF. Just look over here. It is 100% there in all the browsers. I have not seen any browser that doesn't give you this option. Okay. Then save it as PDF wherever you want to save, which whatever name. What I've done is I've already saved that. So these are the reports. Okay. I'll open the latest one, latest annual report. Okay. I would want to highlight few things over here before we move ahead. It is Form 10K. It's an annual report. It is for the year ending 31st December 23. 31st December 23. Then this company have some stocks listed by the name KO on New York Stock Exchange. There are some notes, bonds, right? And this is their maturity. Like this is a very, very lengthy, almost 18-20 years bond, right? And this is their ticker. Okay. This is first covering. This is called as covering. So on the covering page, you'll see for every company, they mention in US the shares outstanding near the date of release of report. If I go back to Safari, you'll see, let's go back, cancel. This report was released on 20th February. It is YYMMDD. The 20th February 2020, this report was released for the fiscal year ending 31st December 23. That is for 21st January 23 to 31st December 23. It was released on 20th February. So 20th February, 1 minute before the release of report, can they give shareholders? No. So whatever latest is possible, they try to give. In this case, till 16th February closing, this was there. So 17, 18, 19, we don't have it, right? But this is the latest shares that is outstanding. So this is 4,312 point something million shares, 4.3 billion shares. Okay. Okay. So this is the report. Now going back, we have to also figure out the date of valuation. So this report was released, annual report was released on 20th February 2024. My date of valuation is also this. So currently when I'm recording this video, we are 5-6 months ahead of this, but I don't want to value it today. What I plan to do is I'll try to value company in Feb. Okay. Let's say the valuation that I'm getting is $70 per share. In February, let's say the shares outstanding, the shares value was, let's say, $58. As per me, this should be the value in February, and this was the market price. So it is undervalued. Something worth rupees 70 is available at 58. So I'll recommend buy. Now I want to see if I recommended buy at 58, what kind of results I would have generated. That's why we are keeping it backdated. And one more reason is there. After that, 3 quarterly reports have been released. When we are learning, quarterly adjustment sometimes becomes difficult to teach at the very nascent stage. Once you become mature with the modeling part, then quarterly adjustment is also very much possible. But right now, because we are laying the foundation, I don't want to make it unnecessarily complicated, right? Valuation is mostly a very nice bridge between the story that you are projecting and the numbers that you are putting in. Numbers should match with story, right? So we are trying to do that. That's why we are keeping things very simple. Along with this, in the description, I have shared one Excel sheet. Okay. So I'll open that. This is that Excel sheet. I would want all of you to download it. Do download it. Okay. You can pause the video and download it. I'm waiting. Okay. Now, assuming that you have downloaded the report, now let us continue. Okay, now assuming that you have downloaded this Excel sheet, firstly, let me walk you through this. So what I've done is I've got this historical data. Okay, I've got this historical data. So like inputting this data is going to take a lot of time. So I've already done this. I've got historical data for revenue. I've got historical data for P&L. I've got historical data for CAPEX. Debt, we don't need historical data. Balance sheet, I've got historical data. Cash flow statement, we don't need it. Cost of capital, we don't need it. Valuation sheet, we don't need it. Okay. Now, you'll notice few items are in blue, few items are in black, and few items are in green. So what's the significance? So I'll just explain you. Green is when you're linking from other sheet, like 33014. It is coming from revenue sheet 33014. So when linking between two sheets is there, we use green color. Okay. When hard punch data, hard coded data, like I have to literally write this 18,000, right? So that is in blue. So all the hard coded data is in blue. And when you are doing some calculations, that is going to be in black. Okay. This is universally accepted. Like if you go to, let's say, some investment bank having office in New York, they will follow this. Okay. So this is how we do it. Now this revenue data, I'll help you to understand from where we are getting this. So this is the report. I'll search for their P&L firstly. So what I do is I press Control F and I have to go to their P&L, right? So I'll search total assets and it will take me to balance sheet. And just 1 or 2 pages above below balance sheet, there will be P&L. Okay. This is their P&L, consolidated statement of income. In US, they call P&L as statement of income. So we've got historical data 21, 22, 23 over here. 21, 22, 23. Similarly, I've downloaded other year's report as well. So I have 23 report, I have 22 report, I have 21 report, and I have 2020 report. Okay, these reports are there. So it is 2022, 2020, 2023, and 2021. Okay, so these reports are there. Now we have 3 years data in this report, right? 2020 data, I'll go and open another report. So maybe let's go and open 2022 report. Here it is. Control F, total assets. This is 2020 data as well. Okay. But you will see I have breakup of revenue. I have not written directly, let's say 33014. I have 33014 and its breakup, right? So when we are forecasting revenue, revenue is the most important thing to forecast, right? Because cost will mostly expand as a proportion of revenue, but broadly, right? Not always, but broadly. But revenue is something that becomes very difficult to forecast. And we want to be as granular as possible. So what I've done is, this is revenue of one of the regions that they have, Europe, Middle East, and Africa. So from where you got this, let maybe search 8078. Let's go over here, 8,078. This is page number 119. They have these segments: Latin America, America, Africa, Middle East, Europe, APAC, Global Ventures, Bottling Investments, HO, that is corporate. Some elimination, like elimination is, let's say, if Global Ventures have sold something to Asia Pacific, so Global Ventures will record it as their revenue. But at group level, it's not a revenue. You are selling it to another division. So eliminate these things and you are left with operating revenues. Okay. So this, let's say I want this 6057 or let's say 8078. This is over here, 8078. Okay. So I've taken this net operating revenue for this year. Similarly, I can get it for previous year as well. 7860. Let's check the number. It is 7523. Okay. Here it is. For each division, I've got the revenue. Okay. So I've got revenue over here. Okay. And then I've calculated the growth rate. So growth rate, if something is becoming from 6057 to 7193, the growth rate is of 18%. Then it tapered down to 4.6%. Then it tapered down to 7.4%. Right. But right now, if you see this growth may be coming because of M&A activities. How do you know that 6 became 7 without M&A? So we need to check and eliminate the M&A part. So inorganic activity I need to eliminate so that I can come up with organic growth rate, and then basis that I'll forecast it. So now the job is to find organic numbers over here. Okay. It must be given somewhere over here. It's just that we have to find it. So let's search organic. No. Then let us search volume. These are the keywords that you automatically learn as you keep on like practicing. Okay. What is this? Nope. Information about volume growth. We want volume, price, and other things combined. It must be there. Here it is. So like this, Europe, Middle East, Africa, this division have grown by 7%. They've done rounding off. Okay. Rounding off they've done. We are also getting the growth is 7%. But this 7% is coming 19% because of price, product, and geography mix, that is organic. 12% is coming negative, 12% is coming because of foreign exchange fluctuations. So we can't predict foreign exchange fluctuations, right? So we will have to move this 7 to 19%. Okay, so I'll just go here. Add less inorganic growth. Okay, here it is 12%. So organic growth is this plus this 19.4. Okay, we'll do it for every subdivision. Let's do it. Then here we have total 19. What we are getting is total 18.7, that is 19. Out of which 6 is coming and 16 is coming organically. Remaining is coming inorganically. So you have to reverse this. We'll have to add 3. So this plus this. We'll copy this as well. Then 7, we already have 8 and minus 1. Okay. And everything is organic. These two are inorganic. This is foreign exchange fluctuation. This is acquisitions and divestitures. We can't forecast Coca-Cola is going to purchase XYZ company in future. We are also not going to consider this as a growth impact. So I'll remove this. Nothing, no adjustment to be done over here. So let it be. Then we have APAC. This was APAC. APAC it is 0%. 5 organic and 5 negative and plus 1 is inorganic. So we'll just remove our impact of this plus 4%, this plus this. It should be 4.2, right? It should be this. It should be organic is 5. It should be 5. So I think it's not adding up due to rounding. Certain rows may not add up to rounding, right? 5 minus 5 plus 1 should not be 0, but it is 0. Anyways, it's fine. We can't be like decimally correct about it. It's fine. Then everything is organic. Now see 5 and 2 can't be 8, but it is coming as 8, 7.8. We'll just leave it as it is. Organic is this plus this. Then 6 and 8, we have to reverse the impact. 6 and 8, 7, 8, they are nullifying each other. Ideally, it should be 6 plus 8, that is 14. We are having negative 4 plus 14. 13.6 rounded off to 14. Then bottling. Bottling is done. Corporate and elimination, nothing is there. Okay, this is done. Now we need to do it for last couple of years as well. We don't have this data over here, but we have the reports. So we can go over here. Let's look for a keyword. Let's use this keyword. Fluctuations. Here it is. Let's make the adjustment. It should be 17% total. Let's go. It's 4.6. You have to make it 17. This should be 17. This is going to be this minus this 12.4. Now it's a tedious exercise, but we have to do it. 17 plus 7 should be there. We are getting 19. Should be 17 plus 7. That is 24. So this plus 7, 6%. We are going to add 24. Then 12 plus 1, 13 should be there. We'll just subtract 6 over here. 13. Then it is 3. It should be 8 plus 3, 11. So we'll make adjustment for 8. This plus this, 11. Then it should be 13. But we have 1. So we'll make adjustment of 12 when it will become 13. 12 plus 7, it should be 19. We are having 10. So we'll make adjustment of 9. This plus this is fine. Then corporate, it's a very minuscule number, not paying a lot of attention on it. Copy, paste, copy, paste. This is done. Now just last 1 year is left. We don't need for this. For that, we'll go to 2021 report. Here it is. We'll use the term fluctuations. See, now I know how to look for this term, right? There's no dictionary for, like, you can look help that will help you to understand which term will be written where. It's easy. So we need 19. We need total 12 plus 6. That is 18, but we have 19. So we'll subtract 1. It is 18. We are getting 17. Okay, so let's subtract 0.5. This plus this. 1%. 17.8 is 18. This is again 18. And we have 18. So no major adjustment to be done. Here also, we have 15. It is 15. No major adjustment to be done. Then 11 minus 2, it should be 9. It is 12. So minus 3, 9. Then 12 and 13 is 33. We are having 41. So we'll remove the impact. Minus 8. Then 12 plus 11 plus 2, 13. It is 15. So we'll remove minus 2. Rest is all sorted. Now on the basis of this, we'll be forecasting. Okay. But before I do this, I've hard punched a lot of numbers. I just want them in blue color, right? Control G on your keyboard, or you can go over here, find and select, go to special. Constants, numbers. So we'll select every constant and I'll give it a blue color. Okay. Okay. This is fine now. Now we have to forecast basis this. Like it was showing the division was 18, then 4, then 7. But actually it is 12 and 12% growth. So I believe this kind of growth will continue in future. It cannot become like, it cannot go like tech companies 50-60% in a year. At 10-12% it will grow. Europe, Middle East, Africa. So maybe African region is having higher growth. European region might not be having that high growth. We'll taper it down over the period. Over this period, let me move myself here. Over the period, this 12 will slowly and slowly taper down. That's my story, right? Actually, you have to do equity research for this. But since we are majorly focusing on the technical part of it, they're saying over the period, this growth is going to taper down. 12 will become over the period around 7%. So we'll say equals to this value minus this value minus this value. We'll fix this. So 12 have to become 7. That is, have to reduce 5 in 5 years. Divided by 5. Next year it will become 11 like this. It will become 10, then 9, 8, then 7. I'll just remove the boundaries. Okay. Then this have been 18, 18, 18. But now we can see it is slightly more than 18. So you'll consider this. It will also taper down. It can't continue to grow. Over the period of time, I'm saying it will taper down to around 12, 13%. And generally, this is what I also like to do. I don't want to be overly optimistic with my valuation. I want to be neutral or slightly pessimistic so that I don't end up making wrong investment decision. So maybe the growth will continue like 20, then 19, then 18, but I'll drop it at a faster rate. So we'll make it around 12% over the period. So I'll copy this formula, paste it. This need to move from here to here, and this need to move from here. Copy, paste. Let me do modification over here. I'll fix the columns. Rows I'll keep flexible. Then this division have already tapered off. See, 14, 12, 7. This is North America. I'm just making it more legible. I believe it will be around this only, 6-7% sale, North America. Let's say it will be 6% over long term. We can copy this. We are saying it's going to linearly fall. 7 have to become 6. I think I need to copy and paste formula here. We need to fix the column. I'll copy this formula. We'll paste it. Now it is fine. Similarly, this is volatile, Asia Pacific. I'm going not, it will grow from 10%, have fallen to 4%. It will grow over the period and will be around 8%. Actually, in reality, you have to do a lot of research for this. Now we will copy this, paste the formula, but we don't want to subtract, we would want to add. And this is happening automatically. So I'll copy, paste. 4 becoming 4.9, 7, 5.7, 6.5, 7.2, and 8. Global ventures, it is around 7-8%. I don't think there will be a major change. We're going to keep it as it is. Then bottling investments, it's growing around 13%, became 19, then dropped to 13. I believe it will remain around this region only. So we'll not do anything. We'll simply link it here. Corporate, so it has grown exponentially, but in absolute terms, it's nothing, right? For a company with $45,000 million revenue, 100 or 120 is a rounding off. So it's going to grow, but very difficult to predict. 80 became 10, then became 34. The company might be doing a lot of internal structuring. So you don't know about it exactly. We'll say, okay, it will be around average of this. $43. And then last, eliminations. Elimination, I'll calculate them like as a percentage of total revenue. So not making any changes over here, right? Now, firstly, let us forecast this. This is going to grow at this rate. It will become this, copy, paste, copy, paste, 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 paste. Should be growing. Let me check. Linking error. It should have been over here. Copy, paste. Now I can copy this. And now it should grow. Yes. Okay. I'll do this. Now corporate, after seeing this, it seems to be becoming too large, right? So I'll just keep it. Instead of taking average of 3, I'll keep it as average of 2 years. Now it is okay. Over the period, 40 became 120, 120 becoming 300. Now makes sense. Now this I'll be calculating as a percentage of revenue. So I'll just write here total revenue before elimination. This is this plus this plus revenue of global ventures plus revenue of Asia Pacific plus revenue of North America plus revenue of Latin America plus revenue of Middle East. Copy and paste. Okay. This is coming as total revenue. Now we can calculate this elimination as a percentage of revenue. I don't need all these things. Elimination as percentage of revenue before elimination. So equals to minus of this by this. So almost 3.1% revenue is getting eliminated. Here also I'll say approximately 3% will get eliminated. Just expand this. Equals to minus of 3% of this. I can calculate total revenue. Total revenue will be this plus this. Copy, paste. I can calculate my revenue growth as well. This divided by this minus 1. 10.2%, settling around 9%. Looks in line. 17 became 11, became 6. So slowly and slowly we are moving towards 9. Will your numbers be matching with my numbers? Of course not. It will never match, right? This is revenue sheet. This revenue will be going to P&L sheet over here and I'll link it. This is the revenue and it will be in green because it is linked from other sheet. Now we have to make adjustment for COGS and other things. So let's proceed ahead. Now we will be forecasting cost of goods sold. So forecasting COGS is really easy. So what you do is you will calculate gross margin. Okay. I've created a separate area for working over here. We are calculating gross margin. So gross margin is gross profit divided by revenue. So it is coming as 59-ish percentage, right? Now we would want to forecast this. If profit margins are going to be 59-ish percentage, what will be the cost? Approximately 40%, right? But here also we need to separate the organic part and inorganic part. So we need a breakup of this. Okay. So it is not there in this 10K report. I've searched for it. It's not there. Okay. So most surely we need to go and download 8K report. So I'll go here. This report came out near 20th February. If I go here, there must be one 8K report that came around this date. Look for 20th February over here. This, right? Near 20th February. Let's go over here. This is their results. It's a press release, not a very lengthy document. But we can find breakup. Let's try to find. Here it is. GAAP, non-GAAP reconciliation. So firstly, I'm going to save this report. So Control P, PDF, 8K 2023. We'll save in this folder. Save. 8K 2023. Okay. Now this report is saved. I'll open this report. And we'll find reconciliation. Here it is. GAAP, non-GAAP reconciliation. Non-GAAP is the numbers without the impact of these extraordinary items. This is for 3 months ending. We don't need this. We need for entire year. This is 3 month. This is the last quarter, Q4. This is 31st December 23. This was the revenue as per GAAP and other numbers as per GAAP. And this is the non-GAAP number. So cost of goods sold, it is 18,520. If I go back, it is written as 18,520. But if this was a normal year, if I remove all the exceptional things, so it would have been 18,465. Let's just go here. We'll say less extraordinary items. In this case, extraordinary item is of 55. So this plus this. This is going to be normalized COGS. Normalized COGS. Okay. Similar thing we have to do over here. Now it should be in black because it is a calculation. Okay. We have to do it for all the numbers. So COGS I am rectifying. Even revenue will be rectified a bit. Okay. But this thing we have already taken care of. So not making major changes in revenue. But you can always do this. This is in itself organic, right? We can make small adjustment over here. 30 should be removed from this as well. Less extraordinary items. This will be normalized revenue. This is 30. So it is getting added. So let's write here add and less. Should be added. So this plus this. But this is going to be in black. And this will be in blue. We don't have to do it every time when we make changes. We'll do it in one go using shortcuts. Copy, paste. Let's check SG&A. No. So we can calculate normalized gross profit. We can even hide this part if we don't need. Okay. Normalized gross profit is going to be revenue minus this 27319, 27319. It is matching. Then SG&A 11 million expenses. We will adjust that. Normalized SG&A. $11 million. We'll make adjustment. This plus this. Then we have other operating charges and operating income. Other operating charges, it is 1951. So everything is extraordinary in nature. We'll just remove them. Minus 1951. This is going to give us normalized operating earning, EBIT, normalized EBIT. This is going to be GP minus normalized SG&A plus this, or let's do normalized operating expenses as well. Let me make adjustment. Add extraordinary, less extraordinary. This will become normalized operating charges. This plus this. So normalized EBIT will be this minus this minus this. 1336, 13336. Okay. This should be in black. This should be in black. Okay. Now we are done with this. Let's move over here. Let's check our margins now. Earlier it was around 60%. Now the margin, normalized GP by normalized sale. This is still more or less the same. Now EBIT margin, let's see. It's 13366 divided by normalized sales. It is 29.1%. Earlier it was 25%. Huge difference, right? So we have done this. That's good. Then this is continued over here on this page. Okay, so let's do the adjustments. Interest expenses, it should have been 1552, but we have 1527. We'll make adjustments. Add less extraordinary item. This is 25. So it will be 1552. Normalized interest expense. This plus this, 1552. It is matching. Then we have 1850. So you have to make adjustment of 159 and equity income. They should be in black. Normalized equity income. Okay. We'll make adjustment of 159. So it is going to become 1850. 1850. Then other income, lot of adjustments need to be made. It is not 570, it is negative 138. If this was a normal year, it would have been 138 negative. But we are showing 570 positive. Add less extraordinary item. Normalized other income and losses. It is 39 plus minus 855 plus 108. So this plus this. This is negative 138 matching. This will lead to income before tax of 14,403. Normalized income before tax. Let's see. EBIT plus income minus expenses plus this equity income, and plus minus will become automatically minus 14,403, 14,403. Income tax, it is 2249. Ideally, it should have been 2737. You're saying as per accounting rules, it is 2249, but it should ideally be, if this was a normal year, we would have paid 2737. So let's remove the impact. Because so many extraordinary items were there, their tax impact will be there. Normalized income tax. Oops. Let's see. This is 14, 27, 48. Plus 71 and 328. So normalized income tax is this plus this. Profit after tax should be 11,660. Let's check. This minus this. Small difference. 14,403. 14,403 minus 2737. Strange. Equals to 14,403 minus 2737. It is 11,666. Some rounding off or calculation error by 6 million. Anyways, earning per share, we can calculate. Whatever is distributable to non-controlling interest, there is no adjustment in it. So we'll keep it same. Earning per share will be 2.69. It is matching 2.69. Okay. So we have normalized this one particular year. Now, because you don't have to again and again prepare this, it's relatively easy process. Okay. I'll show you how quickly it can be done. Hardly one particular year will take 3 to 4 minutes. We have data for 2022, 42 adjustment in sales, then 183 negative in COGS, so GP will change 25,229, 4 million over here, then entire amount minus 1215, then 12345. Let's see, 12345. Interest income, nothing extraordinary. Interest expenses, let's copy paste the formulas. Then we have 24, Then we have 34. Then we have 96, 294 negative, and 443 positive. 17 negative. Then taxation, all these things. 1 plus 113 plus 30 plus 158 plus 128. This is going to be the same. Let's check. Are we getting 10577? Let's check. 2545, 13377. There's some problem in this. We have not considered this last income. 10832, 10. There's again some difference. 1337. This is 10803. We are going to say 13377 minus taxes of 2545. So this plus this should be 10832. But they are giving 10803. Some rounding off error is there. More or less by some few millions here and there, it's correct. Okay. I think okay, I got it. They are giving directly this number. Like previously it was 11660. It is 11803. They are giving 11803 because there is no adjustment in minority. Okay, so they've entirely skipped because there is no adjustment. 2.48, yes, it is matching. You have to do it for 21 and 22. So let's download 21 8K report. Okay, so I'll go here. We don't need this, not this, not this. First, you'll go to 10K, view all 10Ks, and 21 report. This report would have came out over here 22nd February. So let's go and download 8K report that is near 22nd February 22nd 22 22nd February 10th February 2022. This is the report. Here it is. Control P, save as PDF. 8K 2021. Enter. I'll open it. Then we'll use this word reconciliation. Here it is, 3 months ended, 3 months ended, and year ended. 138655 was the sales. This will be adjusted by 3. And next year sale will be adjusted by minus 15. Okay, this is matching. COGS, let's do the calculation. 53 over here and 65 over here. 53 and 65. Let's match the annual gross profits. 23248, 23248 and 19501. 19501. This is correct. Then here let's do the adjustments. It is 5 and nothing. 5 and nothing. Then extraordinary item. It is making entire extraordinary item 0 and 0. See over here. 0 and 0. So it is going to be minus 846 and minus 853. Let's match EBIT. It is 9770. 9770 and this is 11109. 11099. Let's check. 11109. Let's see. 144 is becoming 139. It should have been minus 5. 139 and that is 11109. This is matching. Now this part for 2020, 9770. 9770. This is matching. Let's go to the next page. 821 negative. 776. 776. Then we have 13. Okay. Let's do it over here. Minus 848 and 216. So we are getting 1194 and 953. 1194. Interest expense. 484 adjustment. 484. 953. Let me check. Minus 484. 953. And we have 776. Then 1451 and 1194. 1194 and 1451. Then this is 117 plus. I know it's a tedious exercise, but you have to learn this, right? There is no other way around. 117 plus or minus 1666. If you feel blank out, it happens with many candidates. While they are maybe learning something, they'll just go blank for some time. If it is happening with you, let me know. We can take a pause. Since you are watching it later, you can always pause the video. So 2000, 117 minus, and this should also be minus 367, 367. Then this is 316 plus 14 minus 944 minus 110. 117, guess matching. Then we'll make adjustment for income tax. Equals to 78 plus 263 plus 115 plus 13 minus 1173 plus 706. 9804. It is 2308. Let's check. Oh, I think I made adjustment of wrong numbers. Should not have made adjustment of this. We should have made adjustment of this. income taxes. Profit before tax, it's already matching, right? I'll make correct adjustments over here. The 16 plus 60 plus 29 minus 10 minus 138 plus 140 minus 410, 2308. And let's see over here as well. It is 61 plus 93 plus 22 plus 40 plus 52 minus 207. 2042, yes, it is matching. Final income 8435, 8435, 10086, 10086. This is normalized P&L. Okay. Intentionally, I haven't like put in the numbers over here. Like I did actually hard punch in front of you. Okay. Because I wanted to teach you this part. Then we go to constants, numbers, and color them in. Okay. In one go, everything is done. Let's do the calculations. EBIT margin is this. GP is this. SG&A as a percentage of sales, the normalized one. Normalized SG&A as a percentage of normalized sales. Approximately 30-ish percentage, 30, 31. Operating expenses as a percentage of sales. Earlier I would have done it, but it's just 0, 0, 0. So you don't need this. I'll just remove this. Effective tax rate. How much we are paying on how much income. So we are paying this much on the income of this much, right? Tax divided by profit before tax. We are paying effectively 19%. In future also we'll pay the same. Now we can use this data to forecast the future. Okay. It's going to be on an average on similar lines. SG&A, margins, EBIT, everything. So I'm going to say average of last 4 years. I fix it. In future also it's going to be on similar lines. Now once we have these features, this is what percentage of sales. Once we have these features, we have sales, we can come up with these expenses. There's nothing extraordinary over here. The projections were based on organic data. This plus this. This is my normalized revenue. Normalized COGS. If gross margin is this multiplied by sales multiplied by gross margin is 60% of sales, 59.4% of sale. That means it is going to be this much. If this is operating normalized revenue, this is gross from margin. Difference is COGS. So you can calculate it as a difference. This sales minus this. This is going to be COGS. Right? Similarly, we can forecast SG&A. If this is sales and SG&A is how much percentage of sales? 30% of sales. It's going to be this much. Copy, paste. Other items we don't have to do. EBIT, we can copy and paste the formula. We can calculate EBIT. Then interest income, it will come from cash flow statement. We can't forecast it right now. Interest expenses, debt schedule. We can't use historical data over here. It is based on the level of debt that we forecast for future. We'll put it here. Then equity income, we can't forecast this. This is coming from our various equity investments, right? So we can't forecast this. So many times we say, okay, it's going to be same as past, right? So you're going to do the same thing over here. It's going to be same as past. Some people may say, sir, it is increasing. Yes, we can always do it. I'm not saying this is the only way, but I'm saying like we try to link it with the past. Over the period, this has grown. So let's do one thing. Equity income as a percentage of sales, we can say. Equity income divided by normalized revenue. It's almost 4% of revenue. We'll continue this trend. 3.7% of revenue. So I can forecast this into this. Let's color this as well. Many people consider valuation is some magic wand we'll do plus minus multiply divide and we'll come up with a number. It's such a tedious process, right? We have been doing it from last couple of hours. Then other income, there's no way for us to forecast. We can say it is going to be average of what it has been in last couple of years. There's no way for me to forecast it. And I've used rolling average. Okay, it is taking average of last 5 years. This is obviously not the right answer right now because this will change as we put in the figures over here. Income tax we can calculate is going to be this into almost 19% profit before tax and almost 19% of it. If above figures change, this will also change. Consolidated net income is this. We can calculate net income margin, net margin, net profit margin, consolidated net income by normalized revenue. Coca-Cola operates on the margin of 25%. Right now, we'd be getting it on the higher side because we have not incorporated these two line items, right? Once we incorporate this income and expense is going to be more than this, overall profits will fall and it should come in line with 25-ish percentage. Then consolidated net income minus this minority interest. That is the portion of subsidiary that I don't hold. The portion of subsidiary that I don't hold. So in valuation, this consolidation is done at 100% level. Basically, I've combined remaining 20% of subsidiaries revenue cost with me, though even I don't hold it. So its profit is not going to come to me 100%. So I'm just removing the profit that doesn't belong to me. So we generally, what we do is we say, whatever were the profits, like 8456 was the profit. So almost 21 million out of it was distributed. So 0.2, 0.3% and sometimes losses also are distributed. I'm going to say in future also it's going to continue. 0.1% of profit will not be from my own companies. It will be from subsidiary companies that subsidiaries companies, some part that I don't hold. So copy and paste 0.2%. So whatever this is, into this. So non-controlling interest, this minus this. EPS, we don't generally forecast shares outstanding, though there are techniques to do it by accounting for buybacks. But we'll keep it simple over here. These are going to be our shares outstanding in future. So this divided by this. Earnings divided by shares outstanding. This is my EPS. This will fall. Okay. Dividend have been around 70-ish percentage, right? Dividend per share. So in future also, we believe it's going to be around 70-ish percentage, equals to average of last 3 years, not 4, just 3, because this seems to be extraordinarily high. It's a mature company. I don't think there will be major change in its dividend structure. So whatever I'm going to earn, some percentage of it, 70% of it will be dividend payouts. So if I'm earning 3.09 per share, 70% of it will be 2.18. That will be distributed in the form of dividends and will increase over the period of time. Okay. We'll draw a line over here. Okay. Many of you might not be very comfortable with one thing that I've explained, that is minority interest. In case you already know accounting, well and good. In case you have already studied this before, well and good. Otherwise, I'll explain this to you with the help of example in some time. Okay. Now, this is the entire P&L. Things that we have to figure out is interest income and interest expenses. Rest of the things are figured out. Other than this, everything is done. But I would want to capture few more figures. It is required later on. So I'll do it right now. Okay. Firstly, dividends. Okay. So let's check dividends now. So it is very easy. Average shares outstanding into dividend per share will give you number of shares outstanding into dividend per share. This will calculate dividends distributed, and this is also going to help us to forecast the dividends. This figure will change in future, but more or less it's going to remain on similar lines. Okay. Now EBITDA we have to calculate. For that we need depreciation and amortization. Okay. So we will go to 10K, 10Q, 10K, Control F. I'll search depreciation. Here it is, depreciation and amortization for last 3 years. 1128, 1260, and 1452. 1128, 1260, and 1452. Then we want it for 2020 as well. So I'll go to a dated report and we'll search this. Let's go to this report. Here it is. 2020 is 1536. Okay. This is DNA. The future one we don't know right now, but we can calculate EBITDA. EBIT plus the DNA will give you EBITDA. EBIT plus DNA. So we have added DNA and then this is EBIT. This will give you EBITDA. Okay. This is EBITDA. We can calculate EBITDA margin. This EBITDA divided by normalized revenue. EBITDA margin of the company is around 31%. I hope everyone is comfortable. This is something that we can't put in right now. Okay. because we need this DNA figure. This will come from capex sheet. Okay. With this, we are done with P&L as much as possible. And few things that will come are from capex sheet, debt schedule, and cash flow statement. So we'll go and make those. Let's go to capex sheet. So I have already inserted this data. I'll explain you. Opening balance is previous period's closing balance. So I have gross block, opening balance of gross block, add purchases. This is going to give you closing gross block. I'll write here opening gross block, add net purchases. This is closing gross block. Okay. From this, we'll remove accumulated depreciation. We'll have net block. The historical depreciation and amortization is coming from this P&L sheet. We just inserted this data over here. Previously, I linked it over here. Okay. So depreciation and amortization is this, out of which how much is depreciation and how much is amortization. We have to figure that out. Okay. So let's go to the report. 1,018 from this. Here it is. In property, plant and equipment, this figure was given. Depreciation expense, including depreciation of assets under lease, is 1018, 1125, and 1262 for last 3 years. And I've got this figure over here. So if this is the depreciation, if this is depreciation amortization, so amortization will be the balancing figure, right? If I subtract this minus this minus this is going to be amortization, right? We'll come to amortization figure. Let's firstly focus on depreciation. Now this is depreciation. Property, plant and equipment, I'm getting from their balance sheet. So if I search total assets, in the asset side, they have property, plant and equipment. This is net of depreciation, 9263. But if we search this 9,263 or 36, you will see the breakup. I've used this. Okay. So total plant, property and equipment is 18469, and closing balance was 9236. So this is accumulated depreciation, right? 9223. So 9223. Okay. I've got this. Now, if this is accumulated depreciation for this year closing, last year closing was 1905. This is going to be next year's opening, right? So if something was worth rupees 19,075 million, its closing balance became 18,469 million. How? We must have sold net and net, right? We must have purchased some, sold some, but net and net is sold. So I've just calculated the difference over here. Okay. I've got all these from report. Okay. All these are calculated. This was hard punched. Let me make it blue. Rest of it is coming from here. Okay. Now we can say this formula will apply here as well. Now I have calculated rate of depreciation. So rate of depreciation is, if on 19,700 gross block, this year's depreciation is 1301. So rate of depreciation is 6.6%, between 5.5 to 6.5, right? Over years, you will see the depreciation amount have reduced. So the depreciation rate overall have fallen. I don't think it's going to go anywhere very far away from it. So in future also, I say it's going to be on similar lines. If 5.5% is the depreciation, I've calculated a ratio called as fixed asset turnover ratio. Fixed asset turnover ratio. The formula is sales by fixed assets. Let's say if you're doing sales of 500 rupees and fixed asset rupees of 100 rupees is installed. So your ratio will come as 5x. That means for every 1 rupee invested in fixed assets, you're getting 5 rupees of sales. So this, for this company, it is for every 1 rupee invested, they are getting 1.6 rupees of sale. For every 1 rupee invested, they are getting 2 rupees of sale. And you will see this is increasing over the period, right? Have grown slightly. And I assume this will continue to grow, but not like exceptionally high rate, but will continue to grow. And their efficiency, fixed asset turnover ratio, will reach around 3 over the period. From 1.5, it reached 2.5, and 2.5 to 3, it will reach in 5 years. So nothing very major I am changing. So I'm saying this value plus this value minus this value. I'll fix both of them. Divided by 5. So 2.48 will become 5.8, 6.9, 7.9, 9, and 3. This is my fixed asset turnover ratio. So sales by fixed asset is equals to 2.58. I know sales. So sales by fixed asset is equals to 2.58. Sales by 2.58 is equals to fixed assets. So I can calculate this cross block, right? This was based on this. So I can calculate this as a balancing figure, right? So this will be sales normalized divided by this, enter. This is going to be my gross block. Okay. If this is my gross block, 18,000 is becoming 19,000. How? I would have purchased something net and net. So this minus this, it's showing I have purchased assets of almost $1 billion. Okay. Accumulated depreciation on this will be at the rate of 5%. So depreciation will be this into 5.5%. This is my depreciation. So accumulated depreciation is previous year balance plus this balance. This is my accumulated depreciation. So closing balance will be this minus this. Okay. Are we all comfortable? Yes. This figure we will be able to calculate once we have amortization number. Okay. Now, as per our calculation, or before we move ahead, I hope this is clear to everyone. If we go to their balance sheet, you will see there is one more thing. Trademarks with infinite life. Anything with infinite life, what will be their depreciation and amortization? Nothing. They will not be depreciated, right? But they have some other intangible assets. It's very small amount, but we have to take care of it. 516. So let's search intangible assets. Intangible assets, infinitely lived. It's infinite. It will not have it don't have any depreciation, right? And the following table provides carrying value of our goodwill. So we don't need goodwill. Definitely lived intangible assets. We need this. On this, amortization will be charged. And good thing is, they give for next 5 years what will be their amortization figure. Okay. So the assets that will be amortized, they've given amortization figure. I'll just put it over here. Amortization expenses 61, 54, 42, 42, and 34. Okay. Now, these assets I have considered with infinite life. So other intangible assets with infinite life and indefinitely lived assets. So I'll give you the bifurcation. See, it is given, let's remember this page 139 and let's go to balance sheet. Other intangible asset is a 516. Let's try searching 516. No. Let's search other intangible assets. Let's search intangible assets. Here it is, intangible assets. See, trademarks is 14,349, but this is infinitely living. 14,349, it is infinitely living. Okay. Then we have goodwill. We don't amortize goodwill. We test it for impairment. And then other assets, 500 and 161. This is indefinite life. Okay. Then definitely living intangible assets. This is 355. 355. 355. It's coming from here. Are we all comfortable with this? Okay. So breakup of 516 is some of them are in amortizable and some of them are not amortizable. This cannot be amortized and this will be amortized. Now this is something that I've got. So we have this balance of assets that could be amortized. These are intangible assets with definite life. 355. If someone asks me how you arrived at this 355, this is the carrying value, total accumulated depreciation of 207. Depreciation of 207. So before amortization, the balance will be 562. 562. Last year, this was 707. So how 562 became 707 became 562? You must have sold something, right? So this is how I'm preparing this table. This is 707. So 707, this is the balancing figure. Now we can't forecast these other intangible assets. Very difficult to do. If you go over here, these are customer relationships and trademarks with, where is it? Where is it? These are definitely lived intangible assets, trademark with limited life and some others, right? So these generally like customer relationships are observed in the process of M&A activities. We can't forecast that. Trademarks, very difficult to forecast, especially for such small amount of 60-70 rupees. And similarly other, what we are doing is we are keeping it as constant, like no major purchase sale is happening, and it's some $100 million. We can even be wrong, right? And that's perfectly fine. The next year opening balance is going to be this, and since there is no change, next year's closing balance is going to be this minus this. It's going to be same. Now accumulated amortization will be this balance plus whatever amortization the company have given. So we can arrive at this balance, this minus this. Okay. So this is our balance. There is no way for me to forecast. Other thing that some people do is they will say, okay, sometimes they are disinvesting, sometimes they are investing. So you can take average of it. But I tried doing that and it was showing average will be, they'll keep on selling. Average is coming as minus 89. They cannot keep on selling all their intangible assets. This is a pretty straightforward method now that we have deployed. Okay. Now we can arrive at this balance. This is this. Okay. Then in the other intangible assets with definite life, indefinite life. We can't forecast this. So keeping it same, this balance will become this. Are we all comfortable? This will go to balance sheet. We'll transfer it. If someone asks me what is your DNA activity, this is D, this is A. We have this. Okay. Once we have our DNA activities, depreciation plus amortization, we can go to P&L and can link it here. D&A activities. I'll just no fill it. Once we have DNA activities, we can calculate EBITDA, and we can also calculate EBITDA margin. I told that it will be coming from capex sheet. We got it from capex sheet. Now I don't need to write it over. Now looks fine. Over the period, their EBITDA margin was 31.5, 32%, have moved down around 39%, right? Okay. This is fine. Now I'll just write it as normalized EBITDA. This is done. This was easy. This is done. Now we are left with only two things in P&L: interest income and interest expenses. We're done with capex sheet. Okay. Now we'll move to balance sheet. Okay. We'll come to debt schedule in some time. We can prepare it also, but I'll just prefer you completing this first. Okay. Cash and cash flow. This will come from CFS, cash and cash equivalents. Short-term investments, see, these are the investments that you have done with the intention of disposing them. So sometimes your investments are $1 billion. Sometimes they are $3 billion. Sometimes they are again $1 billion. Sometimes they are $2 billion. So their market value I can't predict. So just keep it at same. This is a treatment that we obtain, what we do with all the investments. So this marketable security, again this, these two also, these are investments. Goodwill also, goodwill emerges when there is M&A activities. So we don't forecast any M&A activities, right? That's not possible. When the company is going to acquire which company, at what value, how much extra they will pay against their book value, like the company that they are acquiring. So anyways, we cannot forecast this. We've got few values that we can put in over here, like property, plant and equipment. This value, enter, copy, paste. Other intangible assets, capex, it was 516, 455, copy, paste. Okay. Total assets, I can copy and paste the formula. These are our working capital. We will forecast them. Other non-current assets, so many things could be mixture over here. We will forecast it, but we will, like, there are two ways. We can keep it constant. It looks to be around $6 to $7 billion. It's perfectly fine even if I don't make any changes over here. Or we can forecast them as a percentage of sales, right? And then we have to show it in the investing activity. Right now I'm keeping it as it is. Deferred tax assets, and here we'll have deferred tax liability as well. Taxation part could be done with a lot of calculations, and more or less it will be around this region only, or they can be forecasted as a percentage of sales, or they can be like specifically forecasted, right, basis the depreciation and all. But what we generally tend to do in a simplified model, we try to keep it on similar lines. Otherwise we can calculate DTA DTL of the company, so their previous losses, which I don't think Coca-Cola will have. Depreciation, what is prescribed in federal income tax, like income tax act of US, what we have over here. Basis this we can forecast, but we are not diving into unnecessary details. Trademarks with infinite life, will not do anything of them, right? They're not dependent on sales. Like uh, we cannot forecast them, like when the company will be getting which kind of trademarks. We'll not uh, try to forecast this. I'll remove these errors. Okay, have been around 14,000. I'm saying let's keep it around that. I can copy and paste this formula. Now mostly I have to forecast this working capital. Okay, and then this also I can copy, paste. Now same with liability. Liability I'll do first equity. Equity is previous balance plus the profits. Now which profit to take? Consolidated or attributable to shareholders of Coca-Cola? Answer is consolidated. Here, if you go, this is consolidated statement of income. Sales is consolidated. If you go to their cash flow, it is consolidated is 10,703. If you go to their cash flow, you'll see 10,703. They're also taking consolidated, and that makes logical sense as well. So consolidated net income plus previous balance. So this is the like profit earned, but this is not the profit that is being retained in the business. So you have 25,000, you made almost 13-14,000, so it became 39,000, but you ended up distributing a lot of it in the form of dividends. So minus the dividends. That's why we forecasted dividends over here. Enter. This is my equity balance. Okay. The non-controlling interest. Non-controlling interest is the people who were minority shareholders of subsidiary. So this is how much, let's say, I have to give them, right? And my subsidiary made profits. So some share of profit I have to give it to them this year as well. So I will be giving them this 25 million, right? This is given to non-controlling interest. Enter. So 1539 was I have to pay them in a way, or their value was 1539. Then this time 25 million of profit is there. 39 plus 25 is becoming 1564. Copy, paste. So total equity will be this plus this. Then deferred income tax, long-term debt, deferred income tax, same as above treatment, keeping it constant. Other non-current liabilities, so many things are there, and I see it. See, everything, every number you don't need to forecast unnecessarily. Even if let's say you spend 30 minutes and you come up with a figure of 8,900, and that is very close to being reality, and I am spending 30 seconds, I am saying it will be 8,500. It's fine. In a company with the balance sheet total of 1 lakh crore, 1 lakh or 1 lakh million dollars, 150, 50, 100, 400 million will not matter much. Copy, paste. This is rounding off for them, right? It's perfectly fine. Long-term debt, we have to forecast. Current liabilities, I can just put the formula over here, but we have to forecast. Accounts payable, working capital, loans and notes payable, accrued income tax, everything will be forecasted now. So this part we have to forecast. This part I have to forecast. And this part also I have to forecast. This part will be coming from working capital. This part working capital. This notes and loans payable, debt schedule. Current maturities of long-term debt, debt schedule. Accrued income tax, working capital. This will also come from debt schedule. Okay. So this is easy. Working capital we'll prepare, then we'll move to debt schedule and then cash flow. And if in case we have done everything correctly, the balance sheet should match. Will it match in one go? I don't know. But there is a high probability, even if it doesn't match, it will take us maybe 30 seconds, 1 minute to identify the error. So sometimes when you're working for multiple hours on a sheet, instead of linking A1, you will link A2. Such linking errors could be there, but fundamentally we would have not done anything wrong. Let's see. So working capital, I've already prepared a format over here. I'll explain you everything. I'm getting this trade receivable from here. Trade receivable is from whom I have to collect money. Okay. Now, if everything, I'm assuming, see, we assume for listed companies that every sale that have been done is on credit basis. So if I have done sale of 45,784, 45,784. So I have done sale on credit, okay, 45,784. My debtor in the last day, on the last day, is of 3144. I assume that this is on an average my debtors throughout the year. So how many times I need to make sale? I make sale of 3,000, then again 3,000, then again 3,000. So how many times sales I need to make so that I can achieve this mark of 45,784? It will be revenue by this, or I can link it with this. This I have to make sales of. This is 2020. My bad. I should have linked with 2020 sales. I'll do it. Equals to my sales for 2020 is 32999. Okay. How many times I need to rotate the cycle so that I achieve, like, my average debtors become 3144. So if this by this 10.5. I'm saying what I'm saying is if you make 3.3114 sales every time, then you make a sale, then you make another sale, you make another sale of 3,144. You do it 10.5 times. Your sales of 32,999, 33,000 will be achieved. Now, if something is happening 10.5 times in a year, how many days it is taking for it to achieve that sales? It is, if something is happening 10.5 times in a year, 365 divided by 10.5, that is my average credit duration, right? So I make a sale, collect money. I make a sale, collect money. So between this, 35 days are required. So if something is happening for 35 days or the average period, I make a sale, collect money, that is for 35 days. And I have done this calculation for all the years. And I'm seeing 35. Earlier, I was taking 35 days to collect my money, then 33, then 30, then 27. So it is reducing my 3 days. But obviously, it will not go beyond a particular point. I'm saying over the period, it will improve, but it will not go, let's say, beyond 18 days. So 27 have to become 18. 27 have to become 18. So it have to reduce by 9 in 5 days, in 5 years. I'll just fix it. So I have to reduce on an average by 2 days. It's not exactly 2, 1.84 each year. So if 27 is reduced by 1.84, it will become 25, so on and so forth. It will become 20 and then 18. This is my debtor days. This is my debtor days. Now, this is called as debtor days. This number, if turnover, how many times you're doing sales, collecting money in a year. That was happening 10 times, increased to post-COVID 13 times. This is also increased, right? I believe you can calculate this. If 25 days is required for me to collect money, how many times I can do it in a year? 365 divided by this. So I'll be able to do it 14 times in a year and improving to 20 times in a year. Now I know my sales. This is my sales. If I have to achieve sales of 50,000 and something is happening 14.4 times in a year, so my average selling price or average credit sales will be of 3,500 rupees. It will increase over the period. It will become 3,500 to 3,568. Over the period, it has improved. Perfectly fine. The sales is also dropping. So this number 3,500 has remained almost on 3,500. And you'll see this is the case earlier as well. Okay. This is receivable forecasting receivable turnover ratio. Receivable turnover ratio formula is sales by receivable. Receivable days is 365 divided by receivable turnover. Okay. This is the one. I'll just put it over here, but you should ideally be writing days over here. Okay. This is dollar million. This is time, so we don't write anything, and this is days. Okay. Now we will forecast. We have forecasted this. We can copy and put it here. Oops, paste link. This is done. Same thing for inventory. Inventory is raw material, finished goods, and work in progress. So combining them, we'll use COGS, cost of goods sold. Cost of goods sold is raw material plus labor. So we'll use cost of goods sold. So instead of sales, we'll be using cost of goods sold. Everything else will remain same. So inventory, the days have been like on an average, we hold 3 months of inventory. Have been similar. We'll say approximately it's going to be same going ahead. Okay. Now inventory turnover ratio. If something is happening in 87 days and have to be in 365 days, how many times it will happen? 4.19 times. If it is happening 4.19 times in a year, my cost of goods sold is 20437. If something is happening 4.19 times in a year, my inventory is stacked up for 90 days. So 90, 90, 180, 270, 360. So my average inventory value will be this number divided by this, right? We've discussed all these things in the previous lectures, right? Inventory turnover in the investment banking classes, inventory turnover, data turnover, everything. Like these are very basic ratio, right? So if we have these inventory figures, I'll just link it here. Paste link. And then prepaid expenses, it's very volatile. 2 billion became 3 billion, 3 billion, and then 5 billion. It doesn't seem to increase in line with anything, but we'll try to link it with sales and we'll see. We can get some precise figure. I did it, and this is the trend that I've followed. So as a percentage of sales, or you can also forecast them as a percentage of COGS and SG&A. This is prepaid expenses. So if you go to your P&L, it must be part of, let me show you here, prepaid expenses. You have paid advance kind of, right? It's a cost. It must be over here or it must be over here. This is extraordinary item. It can't be over here. Definitely it won't be below operating expenses. So I've expressed them as a percentage of COGS and sales, SG&A. So it is visible as, let's go back. It is visible as 8, 11, 10, 16. So I can say it will be 10 to 15% of SG&A and COGS combined, right? So there is like some people can say we'll take average. I'll say okay, let's take this number only. Assuming it's going to be around 15-16%. Some can say sir, rate became 16. In next 5 years, it can become 32. I don't think realistically that's possible, but you might be right as well, right? We can't forecast the future. So 16% of what? COGS and SG&A. So COGS and SG&A. Okay, normalized numbers. Enter. Seems okay. Copy, paste. So 2000 became 5000, 5000 becoming 8000. Now it looks okay. This can also be linked. Okay. With this, we complete our balance sheet except cash flow. So I'll just delete this. No fill. This is done. I'll remove this, but just don't like it. Okay. Then cash flow. It's like to be decided. So we don't know this figure. We can finish this part working capital and this part working capital. Okay. Then rest will come from debt schedule. So let's do this. Accounts payable and accrued expense. Accounts payable and accrued expense. I've got it from the top. I've linked it over here. Then, so ideally, current accounts payable should be linked with uh, purchases. But these companies, accounts payable is people from whom we have purchased raw material. A listed company don't give you figure of purchases. They give you cost of goods sold. That is purchases, raw material plus labor. So we have to do it like this. So we are expressing it as percentage of COGS. It's accrued expenses, so can be percentage of COGS and SG&A as well. So it is coming as 83% of COGS. This divided by normalized COGS, this one, 83%, right? So 83, 95, 88, 84. Let's say very difficult to forecast. It's between like more or less over the period that have remained 84%, 83, 84%. I'm saying it's going to be around this only. If it's going to be around this into 84% of the COGS that I already have forecasted will be this expense. Looks okay to me. 11 became 15, 15 is becoming a 24. But we have kept it at the minimal level, right? The 84 is the smallest amount. If I would have made it 95, it will be far bigger number. Okay. This is fine. We can like take it on the lower side as well. It's perfectly fine. Okay. Then accrued income tax. So we'll express them as a percentage of income tax. So like 788 is the figure of accrued income tax that we have from here. So this divided by P&L income tax expense, normalized one. Okay. It is 40, 30, 50, 60, 40 to 60, 30 to 60. Again, very difficult for us to say exactly what it is going to be. But we have to take a guess and don't be afraid. See, many people say, sir, I'll be wrong. Then what will happen? You will be wrong. You're trying to predict future. You can't predict what you will do next day. And you're trying to forecast of a company next 5 years. Almost impossible. But we can always make our guess. We can always try to make a gamble. So I'm going to say it's going to be average of this. 40-ish percentage. You can also use rolling average. In that case, it will be average of last 5 years every time. It will change. Last 4 years, my bad. It will change. 43, 46. This 43% of income tax. Enter. Copy. Paste. Now we can link these over here. Current liabilities over here. And accrued income tax over here. Okay. Now we are done with everything in balance sheet. This is check. Balance sheet assets should be equals to liability. Currently, it is not. But I would want to help you to like broadly understand where we are heading. Okay. Let's say there is no change over here. Okay. Just doing some rough calculation. No change over here. Balance sheet total is 1,03,000. Cash approximately will be around 10,000. And assuming no change over here as well. So balance sheet total, very minor difference in recent year, and over the period it will obviously like become much wider. So you're on the right track, right? So because I have not this the like I've just populated from the last year. We have not taken the impact of changes in cash flow, but everything seems to be fine, right? Seems to be in a tighter range. Okay, just look at this year. Over the period, cumulative impact is there. Cumulative impact is there. It's 5,000-6,000 each year. This is perfectly fine. So I'll just delete this. I'll copy this. Right now, balance sheet obviously will not match. We don't have debt schedule. We don't have cash flow, but very soon we will have it. So now let's make debt schedule. Okay, debt schedule. Now I don't need historical data for this. Why? Because what I want to forecast, the company would have already given. So I need to firstly search for their debt schedule. So let's search this figure, their debt 35,547. This is their debt schedule. If you just go over here, they've given these are the liabilities that they have to satisfy. This is basically the principal payment that they have to do. They have to retire these debt. I would have used historical data to forecast all these things. I don't need to. That doesn't work in the historical way, right? So this is their future commitments, loan to be repaid. I'll respectfully write this 1960, 24, 25 is 1070. So you'll see there is no trend over here. Whatever you committed in which year, you will pay that. 1 billion became almost 5 billion, then became 3 billion. There is no trend. Okay. This is the loan repayment that we are going to do. Opening balance of long-term debt. Opening balance of long-term debt. So last year's closing will become this year's opening, right? So it is 35,507. 37,507. Okay. 37,507. This 1960 is the short long-term debt that is payable in next 1 year. That's why you will see, remember this page 143? This 1960 is long-term debt, but due in next 1 year. We're preparing it for entire, all the long-term debt. Okay. This is opening balance. Closing balance will be this, this plus loan taken minus loan repaid. This is one way to forecast it. But what do you think? Company is not going to take any loan during these 5 years. Company will engage into it. Check every year the amount becomes different. Right? The company is going to engage into loan taking. Every year company does, right? Such a large company will be engaged into debt activities. So what we do is we will we'll calculate some ratio, and using that we'll calculate the loans. Okay. So firstly, let's figure out the interest part. Average interest rate is given 3.4. Some of them could be on fixed rate, some of them could be on floating rate. We can try to make it bifurcation, and debt schedule could in fact take like 2 hours to complete. A very detailed debt schedule could be there for all the loans the company have taken, notes the company have taken. If I go to first page, These are all the loans, but we are keeping things simple. That's why I'm going to say average interest rate was 3.4%. It's going to be same in future. So copy, paste, and interest expense will be average of opening balance and closing balance into 3.4%. Copy, paste. Okay, this is fine. This is fine. But company is going to take new loans during this period. Impossible the company don't take loan. Don't you believe me? I'll show you. Look at their uh, cash flow statement. This is balance sheet. Cash flow statement. Payment of loans is there and issuance of loans is there. Each year they are taking a lot of loans and they are paying the loans, right? As good as they take, like they repay the new loan and they take new loan. They repay the old loan, they take the new loan. They repay the old loan, they take new loan. Almost of similar amounts, right? Some $1 billion here and there, almost of similar amount. So the company is going to take new loan. How do we figure it out? This method will not work. So we'll use something called as net debt by EBITDA. This is the ratio, net debt by EBITDA. So net debt is total debt minus cash and cash equivalents. But I'm going to modify this formula a bit because we are taking a very simplistic approach. And I'm going to say total long-term debt by EBITDA. The veterans will not agree with this method, but we are we are doing it in a very controlled environment. We want to understand firstly the basics, and then we can bring in the more complexities. So long-term debt by EBITDA. So you might have heard Adani Group over the period have increased its debt. That's what the claim is. But Adani Group comes and say, no, over the period we have decreased the debt. Check our net debt by EBITDA ratio. Debt by EBITDA ratio. So earlier it used to be 12-13. Now it is like on the smaller side, right? But here we'll use total debt by EBITDA. So total debt is, we can take opening balance or we can take closing. Anyone would work. Let's take closing balance. This by EBITDA. EBITDA we calculated this. So it has historically been around 3.4. I'll do it again. Let's do one thing. Let's go to balance sheet and let's calculate here total debt by EBITDA. Total debt, total long-term debt. So total long-term debt, this is the long-term debt. But this also is payable in next 1 year, but it's also part of long-term debt. So long-term debt by EBITDA. Historically, it was 3.59. We can see the company have improved its debt profile, right? And we believe over the period, this will reduce slowly and slowly. 3.59 became 2.59 and the company will repay more debt. So this, let's keep it simple. Let's keep it around this region only. 2.59, it's going to remain on similar lines. Some people may say, sir, because like historically we can see, we can always reduce it. Yes, it is very much possible. Let's say it will become 2.1 over the period or 2 over the period. So we can always say this balance minus this minus this divided by 5. So linearly it will fall. Okay. Now once we have this, let's get it over here. We have used closing balance there as well. So I can arrive at the closing balance by doing 2.47 times of EBITDA. So this ideally should be my closing balance. Now we know opening plus loan taken minus loan repaid is equals to closing. I want to calculate loan taken. So loan taken will be closing plus loan repaid minus opening will be equals to loan taken. So I'll do the same. Closing plus loan repaid minus loan taken minus opening. This is loan taken. This is the loan that we are forecasting that the company will take. Okay, easy. Okay, this is done. Now we can put it on the balance sheet. Current maturities of long-term debt that is payable in next 12 months will be this amount. This amount payable in next 12 months, right? If it is 39,070, this will be like at the end of 24, this is going to be payable in next 12 months. Okay. And balance will be the closing balance of long-term debt. This minus this 37,957. We'll just check. Have we done everything correctly? Let's cross verify. This debt plus this debt should be 39,207. Yes, it is matching. Okay. This is done. And this is also done. Okay. Then we have this loans and notes payable. And then cash flow will be there. Since we have already forecasted this, I'll remove this. I'll remove this. And I'll remove these all as well. Okay. Now, notes and loans payable. 2,000, 3,000, 2,000, 4,000. Let's get the figures. These are all short-term loans. So opening balance will be closing of last year. Okay. Now there is no exact way for me to forecast it unless I prepare a cash flow statement. So the thumb rule is whenever we fall short of cash, we will borrow. Whenever we fall, whenever we have excess cash, we will put it back. It's like CC limit that we have, but we are not making a very complex debt schedule. So what I'll do is I'll express this loans and notes payable as a percentage of total debt, long-term debt. Let's see. Notes and loans payable as percentage of long-term debt. If in case we can find any trend, that's fine. Otherwise, like we have to go and make it a very complex debt schedule. I'm just trying to avoid complexity unnecessarily at the nascent stage. So this divided by sum of this comma this. It is 5%. Historically, 5, 8, 6, 12. I don't see any major trend over here other than it increased, then decreased, and then increased. No major trend is there, but we have to forecast it and keep things simple. I'm saying let it be around same level that it is over here. Okay. Or we have to prepare a very complex debt schedule that we generally learn in LBO model or merger model that we discuss. Okay. So this is going to be 12%. So 12% of this. Okay. This is the closing balance. I'll just put over here. This is the closing balance. Opening balance will be first year's balance will be coming from balance sheet. Next year balance will be this year's closing. Okay. Now, how can we make 4557? How can it become 4742? Would have taken loan, right? You're saying equals to if this balance is more than this balance. Closing is more than opening. So you would have taken this loan. Then give me this minus this. Otherwise, give me 0. Net and net, you have taken this loan. Loan repaid if you want to calculate. In this case, it's always going to be 0 because the way we have kept it at 12%. But if in case it comes, it will be if this figure is less than this figure. Closing is less than opening. Then you would have prepaid the loan. So give me this minus this. Opening minus closing. Otherwise, give me 0. For example, it would be 4,000. So net, this will become 557. I have paid 557. Okay. This is over here. Now we have to, like, we can't use this interest rate. We'll try to find interest rate for short-term debt. So let's search this term, notes and loans payable. And they would have definitely given somewhere the interest rates. Let's see. No. Let's search this figure 4557. Let's search payable. Accrued expenses, leases, notes and loans payable. We tried searching it. I don't know why it never appeared. The weighted average interest rate for commercial paper outstanding was 5.3% as of 23. Okay. So you're going to assume the same 5.3%. 5.3%. In future, it's going to be same. So this into average of this comma this. Enter. Copy. Paste. This is my interest expense. Someone asked me what is your total interest expense. I'll add them together and we'll put it in P&L. Even let's do it. Let's go to balance sheet. Notes payable. This balance. Copy. Paste. Then interest expense will be coming from debt schedule, this balance plus this balance. Copy, paste. Okay. We have this as well. More or less everything is in line. Just this part is pending. We'll be done with this once we prepare a cash flow statement. Come to cash flow statement, and now let's work on cash flow. Okay, now let's work on cash flow statement. We don't need historical data to forecast future cash flows, though there is always like that alternative is also available. We don't do it usually like that. Okay, so net profit is equals to P&L, the consolidated one. Non-cash item, add and less. So DNA will be adding. So like I'm going to prepare cash flow. Here the purpose is to prepare cash flow, not to teach the accounting. Okay. Modeling I'll teach, but cash flow how to make, that's part of accounting. Okay. Then interest expenses. So you are going to add back all the expenses because they are not part of operations activity. The net profit is in the end. You want to arrive at cash flow from operations, right? So we'll add back whatever have been subtracted. Expenses have been subtracted, D&A have been subtracted. So we are going to add it back. So equals to this interest expenses. This one. Copy, paste, interest income will be subtracted. We don't have it, so we are not doing anything. Equals to with a minus sign. I'll just link it here, but we don't have it over here. Then equity income equals to, this is added, so we'll subtract it. Equity income, this is the one. Other income, this is the one. This is cash flow from operation before changes in working capital. Okay, this is fine. Then changes in working capital. These are changes in working capital. So debtors or trade receivables, inventory, prepaid expenses, accounts payable, and accrued income tax. So if asset increases, if asset goes up, the cash balance comes down. Like buy an iPhone, your bank account will reduce, right? So trade receivable, we use the formula always closing minus opening. But cash and asset have negative relation. If other increases, like buy a house, your bank balance will go down. So we have to put a minus sign to account for that relationship here. So minus of closing minus opening, so equals to minus of closing. Closing balance of trade receivables minus opening balance. Or think about it like this. I have to collect for 3,400 from someone. Then I have to collect 3,500 from someone. So net and net, I would have given someone 100 rupees. So I've given cash outflow. If we have done everything correctly, I should see negative 100 or negative 90 in this case, right? Control V. Then we have, let's go to balance sheet. This followed by inventory and prepaid expenses. Equals to with a minus sign. Closing by opening, closing minus opening. We had stock of 4424, then we have 4891. So we would have purchased the stock. So if we have purchased stock, the cash outflow will be there. Copy. paste. And since this is in order, I can even copy paste this formula, copy and paste. Then expenses, accrued expenses and accounts payable. So liabilities and working cash have positive relationship. Like take a loan and cash balance will increase, right? Take a house loan or take a mobile loan, like personal loan. Your bank balance will go up, equals to no minus sign because the relationship is positive. Formula is same, closing minus opening, but no minus sign between before. So this is going to be closing minus opening. Okay. And accrued expenses, income tax, again same, with a plus sign or with no sign is by default plus, closing minus opening. So cash flow from operation is sum of this. Okay. This is cash flow from operations. Investing activity, purchase of plant property and equipment, purchase of intangible assets. So capex sheet, this is purchases, net purchase with a minus sign because cash outflow will happen. Purchase of intangible assets, though we haven't like purchase anything, but I'm going to link it over here. Copy, paste. Interest income, so we subtracted it over here, we'll add it over here. So minus of minus will become plus. Equity income, same. We subtracted it over here, we'll add it over here. And same for other income. I hope you are comfortable. Then total cash from investments is this much. Okay. This is comfortable. Now financing activity, loan taken, loan repaid, interest paid, and dividends. Dividends, I know the figure, so I'll just link it. This is the dividend paid. Then interest paid, I know the figure, so I'll link it with a minus sign. This one, interest expense. Then debt repaid, we know the figure, equals to debt sheet, this balance, right? We are repaying the debt, so cash outflow, this balance. Minus, though we don't have any figure over here, but I'll still put it. This is the debt balance repaid. Debt taken will be equals to this and this plus this. Loan taken. Enter. Copy. Paste. Financing activity. Enter. Copy. Paste. The cash, net cash generated during the year is from operations plus investments plus financing. We had some opening balance as well. This will come from balance sheet. Closing balance will be this plus this, 13,535. This will become next year's opening balance. Copy, paste, copy, paste. Okay. And we have to link it with balance sheet as well. So let me do one thing. Let me link it with balance sheet. This closing balance will go to balance sheet. Copy, paste. I can copy this formula and paste it. and this is going to be okay. So these are the cash balances. You have a balance sheet in which small mismatch is there of almost $1,000 every year. We'll see what's the difference. So let us try to find the differences. First error that I believe mostly we make is of linking. Okay. So theoretically we would have done everything correctly, but some fat finger error, some typo is there. So let me quickly check it. This is fine. This is fine. This is fine. Okay. G11 minus F11, G12 minus F12, G13 minus F13, G29 minus F29. Let's check. Because in working capital, I know I many times, because of lot of things coming together, make some linking error. So balance sheet G and F 11. 11 is trade receivables. Then we have 12, then we have 13. 11, 12, 13. This is F29, G29. Liabilities, yes. This was the error, right? I found it easily. I should have linked with 28. I have linked it with 29. So I'll go and rectify this. 28 and 28. Copy, paste, balance sheet. Oh, small difference, 23. These are the amounts that is creating the difference. 23, 25, 28, 23, 25, 28. Easy to catch it. Now, what mistake I would have done is, here I would have taken, this should be equities net income, the shareholders of Coca-Cola's net income, but I would have taken the consolidated net profit. Let's see, G38 and G59. I'll do this plus this. Oh, instead of 40, I'd have taken 38. So this minus the dividends that you are going to pay. This. Copy, paste. Ta-da! Balance sheet is matching. Now, one problem is there's an extremely high cash balance. Only two reasons could be there because of that. Because mostly we haven't made any major changes in the forecast, right? But cash is highly impacted by this debt, the debt that we are going to maintain. And second one, the dividends that we are going to distribute. Like here, debt. We've assumed this ratio to fall. Balance sheet. If we go and historically look at this ratio was 3.5 coming to 2.59, and then we are assumed that it will fall. What if it remains same, or instead of falling will be around 3? Okay, so let's say this will not fall because that kind of cash balance doesn't make sense. So uh, now this kind of cash balance does not make sense. Extremely large cash balance, not possible, right? The company will prefer repaying a lot of debt or will be distributing it in the form of dividends. Two major reasons could be there where the cash could be utilized. Like we have assumed this ratio from 3.59 to fall to 2.59, it is there. And then we have assumed that it will fall to 2. Maybe it will happen at much aggressive pace. and it will end up around being 1.21, something like this. So a lot of cash is there. Company will repay the debt. So let's see. Yes, because of this, cash balance have fallen drastically. Second one is dividends. Dividends, we have assumed it's going to be remain on similar lines. What if it's going to increase back to around what it has been previously, 85 percentage. So let's say 85%. Let's say this balance plus this balance minus this balance divided by 5. Over the period of time, dividends will, lot of cash is there. What the company will do? It will distribute cash and repay the debts. So dividends have gone up. Let's see the impact on balance sheet. Yes. Cash have now came down. Okay. In fact, this is also a bit higher. In future, I believe this ratio, instead of 1.2, it will be around 1. If this happens, let's see the cash balance. Now it seems to be okay, right? This is also done. Only one thing is pending now. That is, we have to populate this income. So we'll calculate yield on cash. We are having this amount in savings account, FDs, deposits, basically in bank. So how much we are earning? So we'll say it from here equals to whatever is the earning that we are having. This divided by average cash balance. So we are having yield of 3%, 5%, 10% have actually gone up very high. But since this is not a very large amount, I can be perfectly like not so accurate with its prediction. So 3, 5, 10, sir, will become 20, 30, 50. No, it won't happen. Let's say it will remain around 10%ish. You don't generally get such high yield, right, on cash. So if it is going to be 10%, it is going to be 10% of average cash balance, average of this. There is circular reference. That means this interest is being calculated by cash, and the cash balance is being calculated by this interest, right? Interest is going to ultimately impact over here. This will determine the cash balance. It will come over here. It will come over here. And this will determine cash balance. So it's perfectly fine. We can try to avoid it also, or I can enable Excel options. So Excel preferences, if you're using Windows, so Excel options. Then go to calculations, enable iterative calculation. Enable iterative calculation. That's it. And it should be solved. This much we are generating. We generally tend to avoid circular reference. I wanted to bring up this point. That's why I've considered. Otherwise, we generally tend to avoid them. To avoid them, just don't take average. Maybe you can take it on the uh, closing balance. This divided by this. 3 to 10%. This is going to be same. And this can be calculated likewise. Okay. Let it be circular reference. Right now, I'm not making any change. Okay. With this, we complete balance sheet, debt schedule, capex, P&L, revenue, and cash flow statement. Okay. Now I'll do some beautification of this. Like I have to draw a border. So that's historical data, and this data is separated. Same over here. It's already here. It's already here. Okay. Now we have to move towards free cash flow calculation and cost of capital calculation. We are going to calculate free cash flows and then we will calculate cost of capital. Okay, so now let us calculate free cash flows. So cash flows after reinvestments into the business. Okay, so we'll start with EBIT, earning before interest and tax. What are we calculating? Free cash flow to firm. Free cash flow to firm. I just need one extra column over here. Equals to EBIT. I'll go to P&L sheet. We'll link this. Okay. Now, EBIT post tax. So we have to subtract the taxes. Okay. Tax rate. Let's get over here. Marginal tax rate. This is over here. Okay. Now this is effective tax rate. What we need over here is marginal tax rate. Over the period, the company is going to pay tax rate towards what is there in the US. So it is paying right now 19%. It will move to 26-27%. Federal tax rate in US is around 26-27%. Sir, how do you know that? If you go to your browser, if I search KPMG tax rate report, corporate tax table, click on this. It's taking longer than usual to load, but that is fine. Here it is. This is still 2020, and after 2020, there have been no changes in tax rate in US. So United States, here it is. Tax rate is 27%. So like in India, we have GST, CGST, and SGST. In US, they have federal tax rate, that is 21%. And then they have state-wise tax rate, that is between different for different states, ranging between 0 to 12. So 0 to 12 average is 6. 21 plus 6 is 27. Okay, that's how 27. We'll have to increase it to 27%. We'll say this plus bracket open. This I fix it minus this divided by 5. 19 is going to become 29, 21. Let's. Then 21 is going to become 22, 24, 27. Okay. Let's just increase this. Okay. So 19 is becoming 20.6, 22, 23.8, and 27. This is the correct one. We have to divide it by 4 because we took 19 as the base year. Okay. Basically, I'm saying 27 minus 19. It is 8. 8 we have to cover in 4 years. So it will increase by 2%. Okay. So income tax will be this into this. Copy, paste. Now we have to calculate free cash flow to firm. Can I say EBIT is operating profit or profit before tax at firm level? From EBIT, you subtract interest expenses, you arrive at PBT, then you reduce tax, you arrive at net profit. Net profit belongs to equity holder. The claims of debt provider is interest. So interest plus the net profit, that gives you EBIT. EBIT is profit before tax, but at firm level, not at equity level. This is PBT at firm level. So I have subtracted the taxes. We'll arrive at operating profit after tax, or we can say net operating profit after tax. This is at firm level, at firm level. So this minus this. This is the extra money, like whatever expenses you want to do, you have done over here, right? Then you are left with 14,635. On this, you are assuming firm as a whole. If there was no debt equity separate, firm as a whole would have paid this taxes, and it will be this. This is profit after tax of the firm. Now, the expenses that we have done, all these expenses are not in cash, right? So we have to remove the impact of it. So you'll say add depreciation and amortization. It's not a cash expense, and we are calculating cash flow. So this will be added over here. Then after NOPAT, creditors, debtors, COGS, all these things like COGS, sales, etc. Everything, it is not in cash. So we have sales minus cost, but this cost is not incurred in cash. Sales is not incurred in cash, and we are calculating cash flow. So you'll remove the impact of working capital changes. Changes in working capital. So you're going to say, if assets have increased, it is equal to cash outflow. If assets have decreased, that is equals to cash inflow. If liabilities have increased, it is cash inflow. If liabilities have decreased, it is cash outflow. Assets and cash have negative correlation. We have learned this. And liabilities and cash have positive correlation. So that's what we are doing over here. Okay. So equals to, with a minus sign, sum of, or we already have this, equals to sum of. In cash flow, we have changes in working capital already. This part, I'll just take sum of this. This is net changes in working capital. Okay. Then anything else? We will do capex also. Capex, this, or equals to, we'll go to investing activities from cash flow. Willing this is the capex. Right? Whatever is left now, it is available freely to the firm. From this, interest will be paid, dividend will be paid, and money will be retained. We have learned this before. So here I'm going to say free cash flow. FCFF, free cash flow to firm, equals to sum of this. This is free cash flow to firm, free cash flow to firm. Okay, it's easy. Now I'll tell you further steps. We can't do it. We need discount rate after this. This is the cash flow. Like if you look at this, this divided by this minus 1, the cash flow have grown by 10%. But over the period, it has tapered down to around 6%. So 6% is a long-term growth rate of cash flows of the company. Okay. It can even be tapered down, but we are not making any adjustments over there. So it is around 5.7%. But how long do I keep on forecasting? So what we'll do, we'll calculate something called as terminal value. Terminal value. This terminal value is all the cash flows that are going to occur till infinity, present value of it at the end of implicit period, at the end of 2028. How to calculate it, I'll show you, but we are going to calculate terminal value, right? So you'll get some value over here. Let's call it as X, okay? Now we will add cash flows together. This is going to be this plus this. Okay. Here we are getting XXXX, so it's value error, but you will get some cash flow over here. Then we will calculate PV of cash flows. Okay. For that, we will need discount factor. Okay. So we'll discount these cash flows. So I'll write here PV of cash flows, and then we will add it together. This is going to be value of firm. Over here we will get. This is on the valuation date. Okay, this is the value on the valuation date. All these things, present value added together, equals to sum of this. Okay, this is value of firm. We want to arrive at value of equity. Okay, so after this we will make some adjustments. Value of firm is everything combined. From this we'll remove the element of debt and we'll be left with the value of equity. Okay, so this is going to be the entire flow. What to do after this we'll discuss in some time. Okay, before that I need to explain you concept of cost of capital. We'll be calculating beta and we'll be calculating bottom up beta, cost of debt, cost of equity, CAPM model. I need to explain you all that. So we are doing this right now till here, and then we are moving to cost of capital sheet. Okay. Now I'll need some space where I can explain you cost of capital. Let's go back here. Okay, now we are discussing cost of capital. Okay, now we are discussing cost of capital. This is going to be our discount rate. So there are two approaches. What we can do is we have calculated free cash flow to firm. We can also calculate free cash flow to equity. Okay. If it is free cash flow to firm, that is debt plus equity combined, cash flow to them at the combined level to all providers of capital. And this is just cash flow to equity. This cash flow, we are going to calculate present value or we are going to discount using cost of capital. And this cash flow, free cash flow to equity, we are going to discount or calculate present value using cost of equity. And if we have done everything correctly, we should be getting the same answer. Whatever value we are going to get, they are going to be same in case we have done everything correctly. Okay. We are focusing on this method, FCFF. So we have calculated free cash flow to firm for a couple of years. Now we need to discount them. For that, we need to calculate weighted average cost of capital or cost of capital. It is called as WACC, weighted average cost of capital. Now, what is weighted average cost of capital? Weighted average cost of capital is cost of equity, KE, and KD. Okay. Cost of equity and cost of debt combined. Cost of debt and cost of equity combined. But here we cannot just add them together, right? We'll have to give them weight. We are calculating weighted average. So weight will be of market value. So value of equity divided by value of equity plus value of debt. And this will be value of debt divided by value of debt plus value of equity. Okay. So this is the approach. Now it is a chicken and a egg problem. To calculate WACC, you need value of equity. To calculate value of equity, you need WACC. So we use iterative calculation for it, the one that we saw in the interest income, right? Right now, that is perfectly fine. We'll use market value right now over here, and then in future, we are going to replace it with fair value. Okay, so this chicken and the egg problem will be resolved. Now we have to learn how to calculate cost of equity and cost of debt. Let us firstly discuss cost of debt. Lot of approaches are there. I'm discussing three major ones. Okay. First one is survey method. A company or you can go to bank or multiple financial institutions and say a company with such financials at what rate you will give them the current level of loans that they have. Okay. So this is obviously not possible. You cannot go to bank. Second method, you can see their historical interest rate. So historical rate. But this method is only useful. See, 5 years back, the rates were very different. Right now, it is very different. So it doesn't make sense for me to use 5 years back historical rate, right? So what we do is, this method is only useful when lot of debt, number one, number two, is raised recently. Okay. If lot of debt is raised recently, and let's say the company have raised some $1 billion 2 months back at 6%. So they are also going to get it at 6%, right? Another way is you look at their listed bonds yield, and you can use that yield for the entire company, right? This is their rate of return. Fourth method also is possible. This is where you are constructing. So you'll say risk-free rate plus X. This X is based on the risk of the company. So how do you determine that? So let's say your company is AAA rated. Okay. This company is AAA rated. So you'll find what is the risk premium for AAA rated company. And let's say this comes out to be 3%. Risk-free rate is 7%. So 7 plus 3, it will be 10. Okay, so these are primary approaches using which we calculate cost of debt. Then let's move to cost of equity and then we'll calculate them together. Cost of equity. Now, cost of equity, the most popular method is CAPM model. Lesser popular are multi-factor model. Okay. CAPM model, multi-factor model. So these are model-based approaches. And then we have survey method. Sir, what is the survey method? Do one thing. Reach out 1 million retail investors and ask them how much return they expect when they are going to invest in the equity shares of the company. Everyone will give different answer. Take average of it. Not technically possible, right? You can't reach 1 million retail investor. Then do one thing. Reach couple of hundreds fund manager and ask them what is your return expectations from the company. If in case you can find that, calculate average of it and you will be able to come up with the number. Okay, but obviously this is also not possible, so we are not going to focus on this. We'll focus on CAPM model. Okay, then there are many versions of CAPM model. There is global CAPM model where you consider international listings and all, but we are keeping it very simple. We'll use CAPM model. CAPM full form is capital asset pricing model. This says cost of equity is risk-free rate plus X. This X here is different. Risk-free rate plus RM minus RF into beta. Now, I have to discuss all these things. What is risk-free rate? What is RM? What is beta? All these things. Okay. So risk-free rate. The definition which mostly the candidates give is returns that can be earned without taking risk. Technically, this definition is okay, but not, it doesn't give me a lot of details. Okay. So risk free, for any investment to be risk free, it have to satisfy two criterias. Okay. First one is there should not be any risk of default. What do we mean by default? That is very simply, money will be paid on time. What do we mean by this? If money is due on 5th of September, I'll be getting it on 5th of September. It will not become 6th or 7th or 8th of September. I'll be getting it on time, whatever money is due. And second, there is no reinvestment risk. Right? So, no reinvestment risk. Let me explain you this with the help of another example. Let's say it is you who is watching this video, and this is your friend who is watching this video. Now, let's say QuintEdge announces, I will give to these two people uh, an amount. Let's say both of you want to go on world tour. Okay. Now, how much money is good enough for world tour? I got answers from multiple people, and most of them said, if we see right now, it is 2 crore rupees. I offered you and this person, I'm going to give you 2 crore rupees. Do you want to go on world tour? Few of you said, sir, I have my CFA exam, my job is there. So I'll go after maybe 8 years, because right now I cannot like leave my entire job. I'll go after 8 years, or let's make it 10 years. We'll go on world tour after 10 years. After 10 years, then 2 crores will not suffice. Let's say after 10 years, you'll need 4 crore rupees. Okay. Now I have given you 2 crore rupees. Now what will you do with this 2 crore rupees? This is you and this is friend. I gave you and him 2 crore rupees each. Now you went to a bank and said, sir, I have 2 crore rupees. I want to do an FD. The banker will ask, sir, after how many years you need this money back? You said, sir, I want to do like I want this money after 10 years. Okay. And banker said, okay, 10 years rate of interest is, sir, 4% or 5% per annum. And another option banker gave you is, sir, why to invest for 10 years and block your money at 5%? We are offering currently on 1 year FD, we are offering 8% interest. So you can do one thing, do 1 year FD. After that, do 1 year FD. After that, do 1 year FD. Like this, do 10 1 year FD, right? And your friend, he also went to the same bank, everything is same. And he said, sir, I don't have time to like come to you every day, every year, and then manage this 1 year FD. So just want 10 year FD, okay, at 5%. So I'm assuming I have not done the calculation, but after 10 years, let's say this money grows at 5%, in 10 years, it will at least double. So after 10 years, he'll be getting principal of 4 crore, right? That is fixed. So bank may run away. This is SBI. Nothing will happen. Okay. But for you, here, the interest rate were 8%. Then after 1 year, the interest rate change. You're feeling really good. Now you're getting 9%. You're saying, yes, I'll have more than 4 crore. So maybe I'll end up buying some car, some house as well. The next year, the FD rate started declining. It became 5%. Then it became 3%. Then it became 1%. And then remained 1% for next couple of years. And in the end, you came up with principal of 3 lakh, 3 crore, 10 lakhs. And your world tour dream is now shattered. So my question is, in finance, we say risk is equals to uncertainty. What I mean by this, if let's say I purchase share at 100, it can become 110 or it can become 90. Both of them is risky. I don't know what will happen. It may go up, may go down. So we call it as risk. There is a way to quantify risk. If I want to come up, okay, risk is in how much percent? So it is 10% over here, right? How do we come up with? There is a formula of standard deviation, mean, standard deviation, variance from your 12th standard or college days. It's the same thing. This volatility of what is going to happen. This is uncertainty. This is risk. Like I asked this question to most of the candidates in classes. This is world's tallest building. I think it is Burj Khalifa. If a person have to die, okay, have to commit a suicide, you've got two options: to jump from here, QuintEdge building, or to jump from Burj Khalifa. Now, what do you think? Which one is more risky? Which one is more risky? Answer is QuintEdge building. Because if you're going to jump from, let's say, G plus one floor, then in that case, you might die, you might not die. 50-50% chances is there. Sometimes, or if you jump, you will break your legs, limbs, bones, you'll crack your skull, but you'll be okay. Maybe after 6 months, 1 year, you will recover. But if you die from 160 plus floor, I don't know how many floors are there. It's 160 plus. That's what the candidates have told me in previous matches. So I'm assuming that they are telling the correct figure. So if you want to die, if the goal is to die, this is uncertain and this is certain. In finance term, this is more risky. If the goal is to die, and if you jump from G+1 floor, it is risky. If the goal is to die, okay. So this uncertainty is risk in finance. Risk in absolute term is measured by standard deviation. Okay, standard deviation. This is in absolute terms, percentage terms, right? It is measured by standard deviation. So no reinvestment risk. What I mean by this is, if you're going to get your money after 1 year, you invested 2 crore, you got 2 crore 16 lakhs. But you don't know after 1 year at what rate my money will be compounding. It can compound at 9% also, and it can compound at 5% also. Again, uncertainty. This is risk. So risk-free rate is, or risk-free is, there is no default risk and there is no reinvestment risk. Interview question. Okay. No default risk and no reinvestment risk. Now, which are the instruments that are risk-free? The safest instrument that is considered by a particular, like in India, the safest instrument is Government of India bonds. Hello. Government of India bonds, right? But it's a US based company, so it will be Government of US bonds. This is called as treasuries. Okay? Treasury. Now, a lot of government bonds are available. 1 year bond, 2 year bond, 3 year bond, 5 year bond, 10 year bond, 20 year bond, 30 year bond, and all of them have different rates. So this will have maybe 5%, this will have 6%, this will have 6.5%, this will have 7%, this will have 8%, this will have 9.5%, this will have 10%. So which one is risk free? 5 or 10? Very large margin is there, right? So generally we pick 10-year bonds. So we say 10-year government bonds are risk free. Why? See, let's think about it like this. We are in winters. Okay. In winters in Delhi, December end. Temperature is 4 degrees Celsius. This is your house. Okay. And in 5 kilometer radius, there are 50 fruit vendors. Now, in this temperature, somehow you decided I want to eat a mango. What do you think? Will mango be available in abundant? No. Let's say 50 fruit vendors are there. Hardly 2 of them, 3 of them will have it. Okay. Now let's say you want to eat Alfonso. Normal rate for Alfonso is 500 rupees per kg. My question is, this is fair value. My question is, in winters in Delhi at 4-degree temperature, when only 2-3 vendors are selling Alfonso, will you be getting it at more than 500 or will you be getting it at less than 500? Answer is more than 500. Let's say he'll say, I would charge 800 rupees per kg. These vendors will say 800, 850, 900. But the same thing, if they want to do at 40 degrees Celsius in April, can they sell a mango that is worth rupees 500 at 800? No. If he does in summers, all 50 of them will have mangoes. So if someone is selling at 800 rupees per kg and nearby vendor is selling it at 500 per kg, no one will buy from this and more people will buy from him, right? So this person have to reduce this price to 500 to sell it in the market, because in summer there is demand and supply, and if there is demand and supply, the commodity, shares, everything is fairly priced. But if there is lack of demand or lack of supply, it becomes unfair pricing. Now, have you heard your parents who put their, like, they trust FD in State Bank like anything, right? Have you even found them doing a 20, 30-year FD with State Bank of India? No one want to put their money for such a long period. 10 years is like the max, right? So what we want is, our company is going to continue for foreseeable future. Company will operate for very, very long term. Ideally, we should be using very, very long term yield of government bond. So in ideal scenario, it will be a 30-year bond. It's very, very long term. But problem is, these 30-year bonds are not traded much. What do you mean by this not traded much? Means there is lack of demand, lack of supply, right? If in case it is not traded much, it will be unfairly priced. Same will happen with 20-year bond. Not traded much, therefore it is going to be unfairly priced. Basically, we will not get the correct yield that investor is expecting. So, in 5-year, 3-year will be too less of a period for a business that is going to continue for very, very long term. So, 10 years is sweet spot. It is long term as well, and it is liquid as well. Lot of demand supply is there. Okay, that's why we use 10-year risk-free rate. Okay, so I have solved the first RF part. Okay, so risk-free rate. This is going to be a yield of 10-year US Treasury. Now, RM is expected returns from market over long term, right? Here we can calculate based on current market levels, we can calculate the current expected returns from market, but that's a lengthy process. So what we do is, I'll explain you this again with the help of example. Let's say this is real story. Okay, so this is me. I have studied in Madhya Pradesh board. So state board earlier, 5th class used to be a board exam. And this is real story. Okay, so I'll tell you about my marks in first, second, third, fourth class. Okay, so first class, second class, third class, fourth class, and then fifth. First class, my score was 42%. Second class, my score was 44%. Third class, it was 39%. Fourth class, it was 43%. Now, what do you expect my score will be in fifth class? Mostly will say will be approximately around 40%, 2-3% here and there. Right? In reality, My score was 80%. I don't know what happened. All the credit goes to my tuition teacher at that point in time. But what I want to say is expectations of future is based on past performance, right? So the past performance, we can also link it over here. Expected return from the market will be approximately equals to past returns over long term. Okay. So historically, let's say Nifty have given in our context 13% return per annum. So in future also over long term, I expect 13% return per annum, right? That is easy. So RM is also solved. This is done. This is done. RF we already know it's the same thing. This RF and this RF, and then this beta. Beta is a measure of risk, but it is an relative measure of risk. Standard deviation was also measure of risk, but it is an absolute measure. Let me explain you. If let's say this is how movement of one share is, and this is how movement of another share is. So can I say this share is 2 times riskier than this shares? Yes. If this is risk of this share is twice the risk of this share, right? So this is beta is going to be 2. But standard deviation, if someone asks, standard deviation is historically share have moved from here to here and then move from here to here. So this movement, how much this have been, that will be standard deviation, right? Standard deviation maybe for this share is 9% and this share is 6%. Very much possible, right? But beta is 2. Okay. Now, how do we calculate beta? Beta calculation. In beta calculation, there are 2 approaches. One is we have regression beta. This regression beta becomes as an input and we calculate bottom up beta. Okay. This regression beta becomes input and we calculate bottom up beta. This is more reliable. What do we mean by this? We'll come to you in some time. Regression beta, regression beta. So this is now where we are diving into statistics. I'll give you the formula. I'll tell you how to do it on Excel. But right now we are diving on the maths part. Beta is equals to covariance of return of market and return of company divided by variance of return on market. Now variance, covariance, the stats term. I don't want to explain it right now. In case you already know it, well and good. If in case you don't know it, just do a simple Google search and I think you should be able to understand. Now bottom up beta, what we do is we will calculate beta of competitors of the company. Competitor 1, 2, 3, 4. Okay. We'll calculate beta of competitors of the company. And we'll calculate beta of company as well. Okay. Now this regression beta will become input for bottom up beta. Now what we are going to do is from this beta, we will remove Beta is a measure of risk. Risk can be divided into two parts: systematic risk and unsystematic risk. Systematic risk is macroeconomic risk. Like if economy does bad, my company will not be performing well. This is systematic risk. Unsystematic risk is economy, everything is perfectly fine, but there is fire in my company. My management left, right? My margins are shrinking. So that is unsystematic risk. So what we do is unsystematic risk, we call it as company specific risk. Now, company specific risk, we say, comes because of business risk and leverage. That means if you have taken lot of debt, you will be more risky company. And if you are operating in, let's say, a government regulated sector, you are more risky in comparison to other. So you have business risk and leverage risk. Okay. So what we do is, ultimately, I'm saying beta represents business risk and leverage risk. Okay. This is financial leverage. That is your loans. Now, what we do from beta of company, all these competitors, including company, will have should ideally have same business risk because they are competitors operating in the same line, right? So their business risk should be same. Why their risk is different? Their beta will be different because their leverage is different. So what we do is from beta, we will remove leverage risk, beta of company, will remove leverage risk of company, and we will arrive at business risk. Right? We'll obviously not get the same business risk for all of them. So we will calculate it for beta of competitor 1 to whatever number of competitors we have. We'll have their business risk. Now we are going to calculate average of it. Okay. Average of all the competitors number. Now this average of competitors number, I'll say this is average business risk that the company is facing. And we will load this up with leverage risk of company. Okay. So what we did, we had two things. We removed leverage risk. We are left with business risk. We calculate average business risk and we say this is going to be business risk of the company as well. So whatever is the business risk, we load it up with the leverage risk of company. This becomes total risk of company, or this becomes beta, or a better way to call it will be bottom up beta. Okay. So this is calculation for bottom up beta. Now I've explained you everything theoretically and I've not intentionally mixed any practical exercise with it right now. Now my next task is I'll be mixing practical and theory. Okay. So we'll go back to our Excel sheet. Cost of debt and cost of equity have to be calculated. We'll firstly calculate cost of equity, right? We'll work on that. Then we'll calculate cost of debt and then we'll calculate weighted average cost of capital. It's going to be a tedious process, but I've explained you the theory part. Now, when I'm doing this practically over here, I'll explain it to you again. Okay, so that it remains with you for long term. Using this, we'll arrive at cost of capital, weighted average cost of capital WACC. That WACC will be used to discount the cash flows and we'll be able to arrive at value of the firm. And then we have to make certain adjustments over here. We'll be able to arrive at value of equity. So this is the game plan. Now let us start with cost of equity. Okay, so now let us calculate cost of equity. For that, we need risk-free rate of returns. This will be on the date of valuation, so 20th February 2024. I'll go here to Google and will search 10-year US bond yield. We'll open investing.com. Historical data. I need it in February, so let's say 15th February to 25th February. Apply. 20th February. This is yield. Okay, so it's not price. Bond is not available at $4.275. 4.275 is the yield. Okay. You can insert a comment also over here. Insert comment as on 20th February 2024. Okay. This is risk-free rate. Then we have to do RM minus RF. So we need RM. Returns from market. Okay. Returns from market using historical method. For that, we need to calculate this. Let's do it over here. Date, year, and index value. So for this, we need to go to website like investing or yahoo.com. And we'll see NYSE or some US stock exchange. So NYSE, we want to search for index. Okay. NYSE composite. We want to see historical data. This is long dated. We'll go to history, where it is historical data. We would want monthly prices because we have to scroll down. We'll say as large as possible. Okay. We'll keep scrolling down. We're getting our data from 1st January 85. First January 1985. Year is 1985. Index value was 1097.2. 0.02. Then today is this date, but we don't want today's date. We want valuation date. So 20th February 2024. Okay. 2024. And index value on 20th February 2024. Let's see. And we want daily data now. This is the one. 20th February. Index value is 17,340. Adjusted close 17,340. 0.17. So we can calculate difference, or we can calculate like total number of years here. We'll use something called as year frac. Year frac, start date and end date. And we are considering actual by actual. $85 years, 85.01. So let's calculate CAGR. We know the formula, it is closing value by opening value raised to the power 1 by this minus 1. 3.30%. Something wrong with it. Oops, this is wrong, right? This should have been this. It's 39 years and return of the market is 7.31% per annum over long term. So expected return from the market is going to be this. Okay. This is total time. I'll just write here. And this is return of market. Okay. RM, RF, we have to calculate beta. Beta calculation. We need data. Data of Coca-Cola company. Here we'll have price. And then here we'll have returns. And we want Coca-Cola competitors over here. We'll take 4 or 5 competitors. Okay. So for that, we'll go to a website called as Market Screener. Market Screener. I already have an account on this. You can also create. Here we'll go to screeners. Click on this. We'll say we are looking for North American company, Coca-Cola, that is large in size, at least $1 billion or more should be market capital. Sector, it is non-cyclical, food and beverages, beverage company, non-alcoholic beverage company. So many of them are there. We'll just increase it a bit. So these are the companies. This is, oh, we still have India. Let me remove India. Okay. Now these are the companies that are based in North America. So we have some company from Canada, Mexico as well. So we'll use Keurig Dr. Pepper as one of the competitors. Their price and returns. Pepsi is obviously there. PepsiCo. PepsiCo. And we'll have one more company. I think it was Monster. Monster Beverages. Let's see. We have Celsius Holdings. We'll remove its hyperlink. Price and returns. Okay. We'll see last couple of years price and returns. And here we'll compare it with Nifty market. So we have NYSE price and returns. Okay. We want this data now. Let's go back here. We'll say last 5 years of weekly data of NYSE. Let's see we can copy and paste it or not. Okay. These are the dates. I'm not concerned with anything other than adjusted closing price. So we'll get this over here. Date and price. Let's decrease the font size. Okay. We can calculate the returns. Returns is, we don't want this actually. We want data till 20th February. So you'll have to delete this. This is NYSE. Then let's do the same thing for Coca-Cola. Historical data. of last 5 years weekly. I'll copy this and you'll see there are dividends in between. You'll have to eliminate that. Because of this dividends, it's not getting copied properly. So I just don't like it, but we'll have to download and then copy it from various Excel sheets. This is the one. We are not concerned when anything else other than the close price. We even don't want dates. We already have it. This data is from 19 to 24. And the one that we have got is 24 to 19. We'll have to manage for that as well. We want data till February. We'll copy this and we'll paste it in the Excel sheet. Okay, but the dates are in reverse order. So I'll manage dates over here. We'll deal with it in some time. This is Coca-Cola. Then Keurig Dr. Pepper. Historical data. Last 5 years. Weekly data. Download. Show in folder. This is the file. This is again from 19. So now I don't have to make any adjustment. I'll delete it. Till February 24 we'll consider. We don't need dates, just this price. We'll paste it here. Then Pepsi. Let's close these Excel sheets. Pepsi. Historical data. Last 5 years. Weekly. Download. Open it. We don't need anything other than adjusted close. Difference between close and adjusted closes. These closing prices are adjusted for splits, bonuses, dividends, etc. So I'll just need till 15th February this data. I'll paste it here. Then Monster and Celsius. We'll see this. Monster, historical data, last 5 years. Sir, why you are selecting last 5 years and weekly? There is no definite answer for this. I want lot of data points. So last 1 year daily data, last 5 years weekly data. Generally, this is what we prefer. Download. One more company is there. Let me download it for this also. Celsius, Celsius. Celsius Holdings. Historical data. Last 5 years. Weekly. Download. Monster Beverages. And Celsius. It was 1.38. And then became 6, 7, 10, 11. I'm just interested in seeing its graph. From $1, it is 41x rupees, like 41x prices. CELH, I would want to see. 1 year negative 30, 5 year 2000%. This will distort the end. It will not be able to like give us a true picture. Okay. So it is an energy drink company, etc. So I'm ignoring Celsius Holdings. We only need Monster now. Here it is. We just need these numbers. Coca-Cola valuation, Monster, prices. I'll paste it. I just need NYSE data. Because of date, I haven't taken it. Now let's get dates as well. I'll copy it from here only. I'll delete the date, that is after 20th February. We just need NYSE data. It's not available in the order that we want over here. So you'll go to some other website like investing. Historical data of last 5 years. Weekly. Date is from 12th August 19 to 19 February 24. 12th August 19 to 19 February 24. Apply. This is available 18th February. We want 19th. Hmm. 18th August, we have starting from 12th August 19. This is weekly data. The dates are slightly different, so we can't use it. Like it's giving me 11th August 24. Or February, it's giving me 18th February, one day before date it is giving. So I can't use it. I'll be going back to Yahoo Finance and we'll figure out a way. Historical data. Last 5 years. Weekly. Download. I hope it is in proper format so that I can filter, like I can sort the data. Let's see. Okay. That is also starting from 19. So good. Till here. Paste it here. Now we have all the prices. We can calculate returns. Return is closing value divided by opening value minus 1. That means if something worth rupees 12,580 or $12,580 is becoming 12,416, so return is 1.3% negative. Copy, paste, copy, paste, 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 paste. Okay. This is Pepsi, this is Monster, so that I don't have to like find out which information is which. I'll just create a empty space between. Okay. Now we will calculate betas. Beta is covariance by variance. Covariance of sample. It's not the entire data set. It's a small part of the data set. The sample, covariance of return of market, and return of market itself. I'm not going to freeze this. Divided by variance sample only of return of market and return of market itself. So how volatile or how risky market is in comparison to itself. If I have done everything correctly, answer should be 1. It's 1. Beta of market is 1. Beta of Coke. Let's do the freezing. Beta of Coke is 0.73. Beta of KDP is 0.53. PepsiCo 0.64. Monster 0.63. This is their regression betas. I'll just write here regression beta. Now we have to calculate bottom up beta. Bottom up beta calculation. Okay. Bottom up beta. Basically, it is in your books. Sometimes it is referred as unlevering and relevering of beta. So that's what we are going to do. Let's get all the betas over here. Coke, Keurig Dr. Pepper, PepsiCo, Monster Beverages, copy, paste. Name, then regression beta, basically 0.64 means Nifty is or Pepsi is 0.64 times, that is 64 percentage riskier than NYSE. Okay, less riskier than NYSE. Regression beta, then we'll have market cap, then equity or debt. These are market value and market values of like debt. Ideally, we should be using market values, but since we don't have debt market value and very difficult to calculate, we are going to switch to like consider book value almost equals to market value, and that's true for debt. The total capital. Okay. So market cap will take average of last 3 years. Okay. So let's get their market cap. Equals to average of, let's go to this company. Their market cap is given last 3 years. So 2021, 22, and 23. $255,753 million, comma, 275082, comma, 254779. This is their average market cap. Then average debt. Let's calculate debt value. Debt. Here it is. 30136. Then 27518. 28401. So total capital is this plus this. We are going to calculate this for all the companies. Okay. So what we are going to do is we are going to unlever the beta. Okay. So the formula firstly will look like this. Let's go here and let me explain you the formula. First step is unlevering beta. That is, we are going to remove the impact of leverage. So we are going to say regression beta divided by total capital, debt plus equity. So this is risk per unit of capital into only the equity part. So this will give us, without the impact of leverage, what's the risk. Okay. And since we are taking debt, whenever we take debt, we pay interest, and interest will help us in tax saving. So it is 1 minus tax rate. Okay. So debt post tax plus equity in denominator and multiplied by equity. This is unlevering of beta. Let's do it. Unlevered beta equals to this divided by, we have not written tax rate over here. This is marginal tax rate that we take over here. Over long term, if you are going to hold debt, how much you will save in taxes? It is 27%. We have seen this before. Unlevered beta is this divided by debt post tax. I'll fix this. Plus equity. This entire thing in one bracket multiplied by equity. Okay. I've used this formula. So 0.73 became 0.68. Okay. We have to do this for all the companies. We have got it for Coke. Let's do it for Keurig, Dr. Pepper, Pepsi, and Monster beverages. So this is target. And this is competitors, peers. Okay. Now let's do it. Keurig Dr. Pepper, we'll go here, we'll search KDP, that's the ticker. Financials. Analyst forecast. Here we have net debt. I need equity as well. Financial ratios. No. Let's go to valuations. Here it is. 52266. Then we have 50565. Then we have 46593. 46593. Okay. This is total market cap on an average. Average debt 11315. then 11432, and 12924. So I'll just copy this and paste it here. This is my unlevered beta. This is representing business risk. Okay. Let's do it for remaining two companies. PepsiCo, the ticker is PEP. Valuations 241521. 251832. Then 236278. Debt 34346. Then we have 33723. Then we have 34102. Copy, paste. Monster, to the best of memory, it's a debt free company, but we'll check. Monster Beverages. Valuation. Let's reload this. I think it's not allowing us to scroll. So anyways, we can see it over here. 50819. 53011. And 59940. Average debt, let's see. Let's reload it again. Here it is. It's negative net debt. So debt free company. 0. This is 0. So if there is no debt, this beta is unlevered beta. This entire thing is representing business risk. This is representing business risk. We'll calculate average unlevered beta. And I'm in the same business. My business risk, like if this is the business risk, I'm in the same business. I should also be having similar kind of business risk. Now we will be relevering this beta. Relevering this beta. So how do you do that? We'll bring in the impact of debt. Relevered beta. So we'll go back. Now we have beta unlevered. We are going to divide it by equity and multiply it by debt after tax plus equity. Okay. So basically we divide it by debt after tax plus equity and multiply it by equity. Here also we are doing this, but we change this number in process. From beta regression, we move to average beta. Okay. So we unlevered and now we are going to relever this. But this is of competition. This is of the target company. Target company. I'm going to lever myself, or my risk will be dependent on my debt levels. Let's go and relever this. It's put it directly over here. So unlevered beta, average, this. Now we have to relever it. So I need market cap that is available to me, debt that is available to me, total cap available to me. Unlevered, and then this is going to be relevered beta. It is this beta divided by equity. This entire thing multiplied by debt post tax plus equity. 0.6. That is my beta. So regression beta was 0.73, but a more refined beta is 0.6. Order now beta is this. You can calculate cost of equity using CAPM. It is RF plus RM minus RF into beta. It is 6.08. So that simply means if you are investing in Coca-Cola for long term, the expected returns should be around 6-ish percentage. It's a very mature, stable company. This is fine. Okay. We have cost of equity. We'll do all the decoration of the sheet later on. Then we have to calculate cost of debt. Let's make this as cost of equity sheet. Because a lot of calculations are done over here. Let me just do one thing. Go to special, constants. If it's hard coded data, make it blue. Now, other things we'll do later on. Then let's add one more sheet. Let's call it as cost of debt. I don't like the grid lines, so I'll just remove it. Zoom in over here. We'll copy this over here. Cost of debt. One way is to see yields of Coca-Cola bond. Let's go and search. Can we get that? Coca-Cola bond yield. So we'll try to see yield of long-term bond. Okay. So 2093. This is the price. This is not the yield. Okay. This is the price. We want to see yield. OTC. So we can calculate yield over here. Its price is $130, 130.59. Coupon rate is 3.57, and Let's see some more details. It will expire in 2093. Very, very long term bond. If we go to their reports, it must be mentioned. Control F, 2093. This is the one. US dollar notes 2024 to 2093. It's a long term bond. So you can say average rate. This is, we can use this. This rate represents weighted average interest on balance of outstanding at the year end as adjusted for effective interest amount. So you can use this. So they've done some market based calculation, swaps, cross currency swaps, interest rate swaps. So we can use this 3.2 percentage, or we can also calculate the yield over here. So how do you calculate yield? Current market price is 130.569. We need of 20th February. Let's go back and see. Here it is. It was around same 131.179. Twentieth to 2024. Redemption is 2093 minus 2024 is in 69 years. To be precise, 69 years. Okay. We like there might be slight difference because we don't know, we have to check what date it is going to be redeemed. 29 July 2093. So you can write here 29th July 2093. Today or valuation date 20th February 2024. So you can use year frac, time to maturity, year frac, this, comma, this, 30 by 360. Corporate bonds use 30 by 360 as it's a convention. So 69.44 years. Coupon is 7 point something, 7.375. Okay, so 7.375 will be the coupon amount. Coupon rate is 7.375%. Face value is 100. This into this. So you can calculate PV of the bond, PV of the bond, or we can directly, we can calculate yield of the bond, my bad. Yield to maturity equals to rate, number of periods, this, TMT, this, PV with a minus sign, this, future value, this, end of the period. Yield is coming as 5.59%. We can directly use this, right? Simple. This is method 1. Okay. We can also say method 2. This is premium based approach. This is market based approach. This means if we hold this, if we buy it at 131.179, if we hold it for next 69, 70 years, it's going to give us $7.35 every year. So my return from the bond will be 5.59%. Okay. Or we can also use market-based approach. This is market-based approach. We can use another approach. So that is premium-based approach, in which we'll say risk-free rate is this, risk premium. So you have to calculate this. There are ways to calculate it, but right now I'm going to pick up this readily available data. So firstly, I need rating of this company, credit rating of the company. Let me search. It's a triple A rated company or what? Long term was A plus by Standard and Poor. Okay, A plus. And Moody is rating it as A1. Okay. Okay. Now we'll use a cheat code, Damodaran's website. He's the person who introduced valuation to, like, as a profession to most of us. Though my first introduction to Damodaran was not valuation, they've written a lot of books on risk management as well. So that was my first introduction. And then I read his corporate finance book. The website, he doesn't really maintain it to be very fast and all. So it generally takes a lot of time. And he says it's better you use Chrome with it. So let's also use Chrome. Now it loaded. He wrote over here. I've been told that my website is ugly and I'll apologize for its chunky look and feel. While some of you have offered to make it look better for me, I thank you for your kindness. I need to be able to tweak, modify, adapt website as I go along. And to do that, I have to work with what I know about website design, which is not much. You can try search engine below, and if it does not work, try this guide. Basically, is not much interested in making it easier for us. Okay. Then we'll go to data, current data, risk and discount rate, rating spread and interest coverage ratio. I'll click on this. So for non-financial service firm, it is January 2024. We are valuing it in February 24. So it's perfectly fine. So it's a non-financial service firm with a market cap of more than $5 billion. Our rating was, let's go and check, A plus by S&P and A1 by Moody's. For A plus A1, he's saying the premium is 0.92%. 0.92%. We'll go here, we'll add 0.92%. Source, I'll just write Damodaran's website. Let me just paste this. Okay. So my cost of debt becomes this 5.2. So we are getting different answer. It's perfectly fine. These are two methods. Ideally will give you approximately similar answer. but it's fine. This is cost of debt pre-tax. This is also cost of debt pre-tax. This is market-based method, premium-based method, and this is market-based method. Okay, both of them are correct. Post-tax cost of debt, we'll do this. Let's bring marginal tax rate over here. This is post-tax. This into 1 minus tax rate. Okay. Post-tax, this is coming as 3.79. So we can calculate weighted average cost of capital. Back weighted average cost of capital. This is equals to cost of equity into equity by total capital. So cost of equity into weight of equity. Weight of equity. This divided by total capital. This is the weight plus cost of debt post-tax. I'll prefer using this. You can use this as well. Into weight of debt. That is this by this. Bracket close. Enter. Weighted average cost of capital is coming as 5.89%. I've used this formula. This one. This KD. This is post-tax. Okay. So this is KD into 1 minus tax rate. Now we have discount factor 5.89%. So you can calculate terminal value and we can calculate value of the firm. Okay. Now let's calculate PV over here. Formula is 1 upon 1 plus R to the power T. That gives us like value of 12294 after 1 year. Today its value is how much? We have to calculate this. Equals to this divided by 1 plus this. Raised to the power 1, 2, 3, 4, 5. So let me write over here. Equals to this. Present value of it is 1 plus this rate. I fix it to the power 1. These are the present values. We'll come to terminal value. The value of the firm is going to be sum of all this. Let's move back over here. Value of firm equals to sum of this. Now we have to figure out terminal value. Okay. Let's understand the concept of terminal value. So have you heard about arithmetic progression, geometric progression in 7th, 8th standard maths? I don't remember, but it was at least back in my school days. It was taught in 7th standard, 8th standard. We used to call it as APGP series. APGP series. If you look at the cash flows, we are saying cash flows will continue to grow, but how long we can forecast? It will continue to grow and will flatten out. The point at in time at which like the growth rate become constant will continue to move like this in a straight line. So like how long do I forecast? There's no limit to it, right? So growth rate, the numbers that I have calculated shows me the growth rate tapering off and will be around 5-ish percentage in long term, right? So we'll go over here and we'll say growth rate is, let's say, around 5% in long term. Now, the cash flows will be then, let's say, cash flow into 1.06 or 1.05. The next year cash flow is going to be cash flow into 1.05 square. Then next year cash flow will be cash flow into 1.05 cube. Then cash flow into 1.05 to the power 4, like this. It is a geometric progression, right? It is increasing by 1.05 every time. So we'll use this GP series. Sum of GP series, or like we are calculating terminal value. The terminal value, it is inspired from GP series formula as well. Terminal value will be cash flow of next year divided by WACC minus growth rate. Okay. This is free cash flow of next year divided by WACC minus growth rate. What it will give? This is going to give you PV of all cash flows at end of year 5. Okay. So we'll go over here. Very simple formula. Cash flow of next year. This multiplied by, we are saying growth rate is going to be 5% long term. I'll just write here long term growth rate 5%. Now long term growth rate. Let's see what's the long term growth rate for US GDP. 1.9 for 2022. It is around 2% ish, 1.92, right? It was 1.4, 2.8. This is, I just want to see longer term trend. Let me check. One 1.9, last 2.5. Let's see this over multiple years. From 1998, it have been around this region, 1 to 2%. So let's go back and let's say long term growth rate will be around 1 to 2%. Okay. This is my long term growth rate. Now, next year cash flow is this multiplied by 1 plus this. This is my next year cash flow divided by WACC minus growth rate, enter. Okay. So this is coming as my terminal value and its present value. This is coming as value of the firm, value of the firm. This is debt plus equity combined. From this, I'm going to say less value of debt equals to, from where we'll get debt, the current balance. Can go to balance sheet. Sum of notes current maturities of long-term debt, I think, equals to sum of, I'll go to balance sheet and these two, comma, this 40,000 approximately. Add the cash balance, cash and cash equivalents. This is basically value of firm derived from operations. Whatever you have to pay out of it, pay you to your debt providers. You have some surplus, cash and cash equivalents. This plus this will be there. Add investments equals to sum this, comma, this, bracket close, enter. This is going to be value of equity equals to this firm minus debt plus cash plus investments. 367, 321. Number of shares outstanding. Let's get it from P&L. We had it here, 4339. So fair value per share is this by this. It's coming as 84.66 as per my calculation. But the method that we have used right now, it is extremely sensitive to growth rate and WACC. Instead of 5.89, my WACC would have been 6.89 or let's say 7%. Hardly 1 point some percentage difference. Value from 89 will fall to 65. Growth rate instead of 1.9%, I would have assumed 3%. Value from 84 will move to 113. It's extremely sensitive to growth rate. Okay. So what we can do is we can also calculate exit multiple. Exit multiple. So exit multiple is how much times of EBITDA the market is ready to give for such kind of companies. So we calculate EV by EBITDA multiple. We'll just go and check over here. Coca-Cola company. Okay, so I think we have reached the daily limit, but that's perfectly fine. Let's firstly deal with this. What we do is we draw a data table over here so that we can understand the sensitivity. So here we'll have growth rate. Let's just write here growth. And here we have WACC. This is where we'll write WACC and growth. This is the apex point. Like this is the intersection point of this and this. Here we are going to link this value. We'll have input for growth and WACC. WACC, what we have assumed is 5.89%. We'll move it. We'll say this number minus 0.5%. And this number plus 0.5%. Okay. So my WACC would have been anything from 4.4 to 7.5, 4.5 to 7.5. So I've taken this range. Growth rate, I've assumed 1.9, but could be something in this range. So this minus 0.2%. And this plus 0.2%. I'll just create this table. This is the apex point. This is the value. Now we are going to run the data table. I'll select this. Data. What if analysis? Data table. What data is there in my single row? In a single row. WACC. What data is there in a single column? Growth rate. Copy. Paste values. Okay. So it's somewhere around this. Okay. We are in center over here, where my growth rate is 5.9. WACC is 5.9. Growth rate is 1.9. My valuation is coming over here. Okay. So this is it. This is entire DCF valuation. I hope you enjoyed the exercise. I hope you learned something new. All the files description could be found in the description below. And I just want to, like, out of curiosity, I haven't seen PepsiCo's, Coca-Cola's fair value. Okay. So this is it. This is entire DCF exercise. Okay. I'll share this solved sheet. I'll share the raw sheet with you guys. You can play around with it, create your own numbers. You can use this format, do whatever you want to do, just learn. At the same time, out of curiosity, I just want to check what is the price for this company. So as per us, back in February, its fair value was $84. Let's go over here. Coca-Cola share price. Okay, I think let's see what it was around February. It was around $61. As per us, the fair value was $84. So my recommendation will be wholehearted buy. Something worth rupees $84 as per us was available at 60. Then I would have said, okay, go and buy it. And then over the period, 60 have become 68. So it has given good returns of 14% in last, so February, March, April, May, June, July, August. So almost in 6 months, it has given 14% return. So that's the power of valuation. And this is a rough exercise. Please don't use it for any, don't consider this as an investment recommendation. I have taken few shortcuts that as an instructor, I know, but for learning, this is good enough. Okay. So this is it for the DCF exercise. We'll see you guys in some other financial modeling video. Bye-bye.